Ah, okay.
Sometimes we get Brian here if he wants to
Yeah.
come. He's not here today. He was ready. That's other things. We have a board meeting coming up. So. General counsel. Yeah. You go to Yosemite?
Yeah.
Oh, nice.
So we're trying to find out. Well, the thing is, we just want to.
Okay.
Yeah, okay. But if I forget, let me know.
Okay.
If I move from one to the next, I'll stick with it. Oh.
Judge Farkas, good to see you.
Good seeing you, Heather.
You're all set? And I think we actually, we're live now? Oh, we're live. Okay, we're live. All right, folks. Welcome, everybody. Thanks for making our third meeting. As you all know, there's a lot of work that goes on behind the scenes to get us ready for these meetings, and we appreciate very much the work that you have done in between these meetings to get ready for your topic and participate with the presentation of other committee topics. We all know now that there's a tight schedule and a lot of work to do. I was thinking about the presentation we had from the New Jersey bar at our last meeting, and I think I read somewhere that they had 3 or 4 years to pull together their recommendations, which they gave to the bar earlier this year in New Jersey. We are obviously at a much tighter schedule. So thank you for sticking with that. Thanks for doing what you do. Thanks for your commitment to the process. For the live feed here, I am Randy Miller. I am the Malpractice Insurance Working Group Chair, and we will officially kick off our meeting today. We have an ambitious agenda as usual. Thank you. An ambitious agenda as usual, and a fair amount to get through. But I also want to make sure that we leave some time at the end, if we can, to have an open discussion about where we've been, where we're going, what we're going to do next time, so we keep in context exactly where we are. We generally have not done this in our meetings, but I think because we've got a little bit of room in our agenda today. You want this one on? This one's on.
Hello.
Because we have a little bit of room in our agenda today, I wanted to go around and make some introductions, or have you make introductions. We also have committee members that are here for the first time. We've also got some members from the public participating as well, and I'm happy to have you introduce yourself. I know in advance that both of you are going to attend, so we appreciate that. If you have comments at some point during our meeting and you have some time constraints and you want to be heard, we will make time for you to make public comments during the time of our meeting. Otherwise, I would ask for public comments to be made at the end of our meeting, and I'll announce exactly when that will take place. So when we go around, Sonia and David, if I could have you introduce yourselves as well, welcome, and glad to have you with us. So, Dan, can we start with you? Actually, Linda, can we start with you when you get back here? And make sure we have on record who is here and who you are.
I'm Linda Cass, and I'm with the State Bar's Office of Research and Institutional Accountability, and I'm staff to this working group, so if you need any information, please contact me.
Everybody knows Linda by now. She is unbelievably resourceful, and I know she's worked with all the committees and individual members here to get information you need. We have a lot of ongoing projects that we're working on that we don't necessarily announce to everybody, but with collection of data, with the information from the DOI, Linda is spearheading a lot of that. When I'm off, trying cases and being a lawyer Linda handles everything behind the scenes. A lot of that you don't see, but I just wanted to recognize all that you do to keep this process going. We are an ambitious time schedule here, so thank you for that, Linda. Dan, can you tell us about yourself?
Good morning, Dan McKenna with the insurance agency Mitchell and Mitchell. We are up in Novato, and we got some reverb going in. He's the greatest. My agency has been charged with administering and underwriting the CNA Lawyers Professional Liability Program in California for the last 20 years or so. So I've seen the competition, and we've dealt with rates and limits and things like that on a regular basis. I think that's where I add something to the group. Look forward to working with everybody.
Thanks, Dan. Joanne?
Really happy.
I'm nervous. I don't know what's gonna happen.
Our G mics are going out. I don't.
Do we need to do something in our budget?
Yeah, we got, the State Bar got these microphones from Radio Shack. They were like 20 from
It was a great deal at the time.
We had to bring our own batteries.
Bullhorns would be good.
Go figure.
Okay, I'm Joanna Mendoza. I sit on the Board of Trustees. I'm in my 5th year on the board. I'm also a solo practitioner since 2008 for that small firm from 2003, so I think I bring a helpful perspective and perspective.
I'm Joanne's friend. My name is Heather Rosing, and I was on the Board of Trustees for 4 years, served with Joanna, in fact. I am currently the president of the California Bar Foundation, as well as the new California Lawyers Association. And I also have the privilege of serving as a legal advisor to the Rules Revision Commission, and have worked closely with Greg and others rewriting the rules of professional conduct over the last couple of years. I'm a private practitioner at the Kleinden's PC firm, where I specialize in legal malpractice and engage in advice pertaining to ethics and risk management. And same practice area as Randy and Glenn, pretty much.
Thank you, Heather. Welcome.
Hi, I'm Glenn Olson, and I'm a professional liability defense litigator with Long & Levitt in San Francisco. I had the privilege of being on the Copley committee with Randy as co-chair for, gosh, I don't know, 3 or 4 years, and probably a member of that committee for maybe 8 or 9. And in one of my prior lives, I was the claims officer for lawyers and accountants at CNA, and had the privilege of working with Dan McKenna. So I look forward to working with you folks as well.
Thanks, man.
I'm Connie Broussard. I am in private practice. I have my own firm, Broussard Law, in San Diego. I do primarily employment law, and I also serve on the commission on the Council on Access and Fairness for the State Bar.
Thanks, Connie. Scott?
Hi, I'm Scott Garner. I'm a partner at Umberg Zipser in Irvine, California. My practice is similar to Greg's and Heather's and yours. Malpractice defense, ethics counseling. I'm a recent former chair of COPRAC, which is the State Bar's Ethics Committee, and I'm currently the co-chair of the Orange County Bar Association's Ethics Committee.
Great. Thanks, Scott. Wes?
Wesley Lowe from San Francisco. I'm in private practice with the law firm of Mannion, Lowe & Oxenendler. We're a 4-lawyer firm, and we primarily handle insurance coverage and insurance bad faith on behalf of the policyholder.
Thanks, Wes. Welcome.
My name is Scott Barabash. I'm with Aspen Insurance. I'm located in San Francisco as well. I oversee lawyers and accountants claims for Aspen Insurance. I've been doing this for about 15 years, and hopefully I'll be able to bring a perspective from the insurance carrier and how we see potential for mandatory coverage and other issues that arise in this working group.
Yes. Mr. Moots, first time here.
Hi, yes, I'm Jay Moots. I'm a professor at McGeorge School of Law in Sacramento. I teach insurance law. I was dean for 5 years and worked on a committee dealing with the bar pass results, which inflamed passions, and that was very interesting work. And I look forward to participating with this group to talk about malpractice insurance.
Thanks, Jay. Jay was appointed late, and know you had a conflict at the last meeting, so thanks for joining us today. I know you had a little catching up to do, so we appreciate your work and commitment. Thanks, Jay. Judge?
Hi, I'm Alan Perkins, Judge, Sacramento Superior Court. I primarily supervise our complex civil litigation docket, primarily tri-civil cases. I was in private practice in Sacramento before that.
Kath Sargent, Vice President of Underwriting and Marketing with Lawyers Mutual, a legal malpractice carrier. Previously, I was an insurance defense lawyer for lawyers who were sued for legal malpractice. Been with Lawyers Mutual about 30 plus years, so I have a lot of experience from the insurance side and dealing with lawyers in our, as well as loss prevention and other kinds of things that we help lawyers prevent claims for.
Thank you. Great.
Hi, I'm Greg Fortescue. I'm a lead attorney for the California Supreme Court, focusing, among other things, on state bar matters. And here's the court's liaison to working group. And my more recent group that I was participating in with Heather was the Rules Revision Commission. Looking forward to working with everyone.
Good morning, I'm Mark Schacht. I am an attorney with the State Bar's Office of General Counsel, and I'm here primarily to serve a supporting role and offer legal advice as needed, particularly about open meetings requirements, and anything else you may have questions about.
Great. And we had a couple of you come in late. Can you introduce yourself for us, Leah?
Sure. Leah Wilson, Executive Director of the State Bar.
Thank you. And Sabrina?
Hi, Sabrina Green. Malpractice insurance working group.
Very succinct. That's your official title. You have to announce yourself like that now until the end of time. Good. And then Sonia, one of our public participants here today. Can you just briefly introduce yourself?
Sonia Crow. I'm with Mercer, and Mercer administers the State Bar-sponsored Lawyers Professional Liability Program through ARCH. So I'm standing in for Richard O'Regan, which you may know. And we have an interest on this because it may have an impact on our program and our business model.
Very good. Great to have you here today with us. Thanks, Sonia. And Dave?
Good morning. My name is David Carr. I'm a solo practitioner in San Diego, and I am in my 30th year dealing with legal ethics and State Bar staff. So, thank you for having me.
Good, yeah, and again, for any comments from the public, we'll do that at the end. But if you have time restrictions, let us know and we'll fit you in someplace. Otherwise, welcome. Thanks for your participation. So we've got an interesting agenda today. As you know, we're basically dividing each of the meetings up among the committees. And as you know, we've organized the committees around the legislative questions that we have been asked to assess and analyze and make some recommendations over. And today, the committee that is studying two questions, the adequacy and availability of insurance coverage, will be speaking. I know that Joanne and Dan will kick off that discussion, and I invite all of you, this is true for all of the topics that we go through, to listen intently, ask questions, get information, whether it's just for the good of the cause or whether it would be helpful to your assignment on your particular committee, because obviously as this process continues and winnows down to the preparation of what will be a significant undertaking, a written report, first to the State Bar on all of our findings, the work is going to get more demanding, and we'll need to ultimately form some opinions and recommendations for each of these topics that we've been asked to assess. So I know that you're all committed to the process and listening intently, but make sure that you inform yourself as best you can as we present the topics. Last time, headed by Heather and her committee, with respect to the open market model of mandatory insurance. That is one of the biggies, and at some point we're going to need to put pen to paper on how we ultimately come out on this. Fortunately, again, this is not the first time this has been done by the State Bar, but certainly going to be the most comprehensive and well-studied. And also now we know that we're not the first state to look at this very closely, or at least in addition to Oregon over the last 30 years or so. Now we've got Iowa and Nevada that are have instituted these programs, so we are well along in our charge here. Sort of as an aside, an exciting time, we're going to get an announcement of a Supreme Court nominee sometime tonight, right? Do I have that right? It's going to be on TV, but being a McGeorge guy and Mr. Moots being a McGeorge guy, we both had the pleasure of dealing with Justice Kennedy when he was a professor at McGeorge many years ago, and now that we've seen his retirement through, I guess we're at another crossroads to see where we stand with that. So exciting time for the profession and citizens, so we'll see. Anything else before we get going in terms of the introduction of today's topic that anybody wants to discuss, talk about, anything that we want to review for the last set of meetings? Otherwise, I'll turn it over to Dan and Joanne to introduce today's topic. Anything at all? I know I talked about this earlier, but there's since the committees were formed and had the opportunity to start to get your arms around your topics, I know that you each look to various sources of information that would be helpful to your topic. Today, we're going to talk about adequacy of insurance and sub-issues like the amount of insurance and eroding limits and those sorts of things. That information is out there. I mean, we have the luxury of having LMIC part of our group through Kathy. They have that information. We have asked the Department of Insurance in California to provide us with their information, which is going to take some time to extract. It's not necessarily kept in a super organized way, but through Dan and Joanne's committee and Linda and I, we crafted a letter to the Department of Insurance probably about a month or 6 weeks ago now to ask them. I think that was actually the suggestion of one of our committee members at our last meeting to see what sort of information they had on file. And again, it's not organized in a way that's immediately extractable, but at some point they'll be responsive to a number of categories of information they asked, obviously dealing with legal malpractice insurance, professional liability insurance, and who give us perhaps a better idea, hopefully, of who's writing in California and the types of programs and the types of insurance limits that are available, all of which have bearing on the topic that we're going to talk about today. So I wanted you to know that those efforts are ongoing both through the committee and through Linda and I to reach out to obtain that information. We all have, we in this room, since we all follow these topics pretty closely, probably have a pretty good idea of what's out there, but the devil is in the details, especially when it comes to the question today about the adequacy of insurance, LPL insurance being offered. It's really helpful to have exactly what's going on, and the legislature wants us to provide it. So that's one of our charges here. But I think we all have a general idea of what the actuaries tell us is going on out there in the world, and we're going to have to dig deep to make sure that we present in a very comprehensive way to the State Bar Board of Trustees exactly what's going on out there, and for them to determine, and later the legislature to determine whether the industry is going in the right direction or not. So I want you to be aware that all those efforts are ongoing on behalf of the insurance working group as a whole and within the committees. And if you have ideas along the way of other data that we can mine or get access to that would help us on this question and our overall charge to prepare our recommendations to the State Bar, please let us know or pipe up today. Unless there's anything else, I'll have Dan and Joanne introduce your topic and we can get underway.
Thanks, Randy.
Yeah, absolutely.
Joanne, Lisa, and I have been charged with the adequacy, availability, and affordability of professional liability insurance. Lisa's unable to attend, so Joanne and I will do the best we can on this. She was kind of the leader of our group. But, the affordability of insurance, on that portion of this, I found that actuaries, whether it's CNA or any of our competitors, actuaries are the busiest people in the world. Trying to get information from CNA specifically, they're backlogged, they need more people, and it's been very slow in coming. And as I said to you earlier, Andy, the amount of information I was able to obtain from CNA, I already kind of had in my head, so it wasn't very enlightening. On the availability, right now, well, first let me say, we're working with a moving target. Right now, we're still in what's referred to in the insurance business as the soft market. It's hardening ever so slightly, but right now there are plenty of carriers to take premium to write business in California. We've got 17 admitted carriers and 18 non-admitted, and that was as of a couple of months ago. I wouldn't be surprised if there's 20 admitted now. There's been some changes with Zurich and their distribution and a couple of other carriers. Kathy, you may have more information on that out of town.
There's just been a switch with Zurich pulling out and some other entities coming into the market, but reinventing themselves, not really too much of a change in the number.
Right, so 17, 18 non-admitted carriers is right now where we're at, and it's been in that range for several years now.
Can you explain the difference between admitted and not admitted for those in the room who haven't tracked this very closely, and also maybe those on the live feed following this?
Sure. An admitted carrier will file their rates and forms with the Department of Insurance here in California. They also participate in a guarantee fund whereby if one of the admitted carriers goes out of business, the other or the fund will pay, I think it's up to $100,000 on a claim against that carrier that's gone bankrupt. They have to stay within their filing guidelines, and that's where, when we're discussing with a potential insured the idea of working with a non-admitted carrier, we don't really emphasize the $100,000 of coverage if in fact the carrier goes bankrupt, because that doesn't happen very often, and $100,000 is unfortunately so much money these days. But we'll discuss the idea that an admitted carrier has to stay within filed guidelines. They can't unconscionably raise your rates beyond what's been filed, and there's rules that they've got to play within. Whereas a non-admitted, there's a list of carriers that are quasi-approved in California. I think it's called the Leslie list, whereby these carriers have financial viability to them, and they're doing business in the state licensed as quote-unquote a non-admitted carrier. Their rates can change overnight. They can put manuscript endorsements on policy. They can exclude coverage on something they see they don't like immediately. So you have less rule and order with a non-admitted carrier.
And this is probably a horrendously difficult question, but any estimate, even anecdotally, of the breakdown of those that are insured in California by an admitted carrier versus a non-admitted carrier?
Significantly more with the admitted, I would say. Kathy or Scott, you admitted versus non-admitted, percentage of people that are insured by each, or?
I would hope more admitted.
Yeah. I mean, when I look at solicitations that come back, I would say 80% are with admitted carriers. The folks that are with the non-admitted market are people that are in entertainment law, or intellectual property, people that have had claim history of some significance, and typically they pay more. Nowadays, though, the market is so soft that we do see non-admitted programs with low premiums. It used to be a non-admitted carrier would have a premium of approximately $10,000 as their minimum premium.
Right.
And that's changed over the last dozen years.
Used to be sort of perhaps carriers of last resort, and there was
Right.
that safety net of the non-admitted carriers if you weren't approved in the admitted market because of a bad claim history or some other redlined areas of practice in California, you'd end up in the non-admitted market.
Correct.
And it used to have some significance because every once in a while, a non-admitted carrier would be liquidated, and there'd be a need to draw upon SICA funds or some other protection so that the insurers were ultimately had some available, at least some minimal available coverage. So it used to be that. We haven't had that situation, I think, in a number of years, but we all went through that at one point or another.
Yeah.
Yeah, okay. So there is a difference.
Yeah, I would just add that I think you could also have a company that has an admitted product and a non-admitted product. So, I mean, I know we do that. We probably issue more of the admitted product, but that's more because for us, that goes a lot with the smaller law firms. And the non-admitted product is for a lot of the larger firms.
Exactly. And with CNA specifically, CNA uses a company, Continental Casualty, for all the business that Mitchell & Mitchell that we write in California, but then they'll use Columbia Casualty, which is a non-admitted carrier, to do their intellectual property program. So that is where there's many nuances to the firm. Some intellectual property firms deal more heavily than others with patent work versus litigation, and also they have to fine-tune the rates, with each individual risk. The same thing with claims. A firm that has had a lot of claims, it's hard to underwrite that in an admitted program because each claim could have special impact of its own on the underwriting process. So I'd say at least 70% of California insurers right now are with admitted carriers.
Okay, and would that be even a greater percentage for the small solo and 1 to 5 practitioners, law firms out there that would have even a greater concentration in the admitted market? It sounds like.
I think so.
Yeah.
At least from my perspective, or from my company perspective, it's definitely that way.
Okay. But of course, for those practitioners, the 1 to 5, just focusing on them for a minute, if they have a difficult claims history, then they're going to have to look to the non-admitted market.
Correct.
Is there a greater risk to an insured who ends up in a non-admitted market, just given the fact that it's not as regulated, the policy may be not as generous with coverage, or other reasons? Just because we're talking about the idea of adequacy of coverage, we want to make sure that we look at all angles.
Definitely, there's more risk in the non-admitted market in the sense that the non-admitted carriers don't have to give notices as far as removing or leaving the state or offering their program anymore. Like Lloyd's of London is probably the biggest non-admitted market out there, and they have hundreds and hundreds of syndicates. And one syndicate might write business for a while, incur a significant amount of losses, and decide they're not going to write in that syndicate, and they could just leave an insured high and dry very quickly. Whereas in the admitted market, you've got notices, 60-day requirements to give insureds a heads up, and also again going back to the idea of the filed rates in a non-admitted market. If a carrier is seeing a lot of activity in wills and estates, for instance, there they can simply double or triple the rates. Where in an admitted market or an admitted carrier, the rates are subject to the filings, so therefore they've got to either refile the rates, which is noticed, and people with brokers have time to react to that, or they've certainly got to give 60 days to the insured in way of notice. So they've got to stay within what they've got filed.
So there's one of the risks is if you're with a non-admitted carrier, and because there's not a filing with the Department of Insurance, the rate could go up. You can go up dramatically in year 2 or 3. It might be a nice honeymoon rate year 1, but depending on the market conditions, which of course everybody doesn't control, it could escalate in year 2 and 3.
Absolutely.
And it would become effectively unaffordable.
Correct.
Go.
Kat had a question.
A note, because the DOI does regulate the rates with admitted carriers, they have a say-so. If you are unreasonable or making too much profit, they control the amount of profit that you can make as an insurance company. So for example, with this new tax break there, they have now noticed all carriers that they expect a large rate decrease based on the new tax laws, and they are looking to insurance companies on a very regulated basis. They're going to go over their financials to determine whether or not they're making too much money, in which case they will require, and they can also penalize insurers if you charge an unreasonable rate, whereas the non-admitted carriers don't have none of that regulation. They can, as Dan was saying, they can charge whatever they want, however they want, whenever they want.
Interesting. On the profitability, I always thought that was just a healthcare initiative. It's across the board.
It's across the board. They are looking to malpractice carriers in the same way.
I would just add, as far as the one difference, and this might not be applicable as much, but I guess on the non-admitted policies, there's more room for negotiation of the terms of the policy on both sides. So if you have a sophisticated insured, they might be able to get something that, you know, maybe be a little bit more unique that you wouldn't otherwise get in the admitted product. So that's just one of the reasons, one of the benefits, I guess, of the non-admitted.
Would that be true for the 1 to 5s?
I think it
more so with the larger firms.
More so, I think for me, larger firms are more unique practices because they, I think they have more. I think there's more flexibility in that policy. As you said, there's flexibility where they can often pull out, where they can do things with the rates or deductibles and things that are a little different. But there's also more flexibility on getting certain coverages that may not be offered under the admitted policy.
Very true. That, for instance, entertainment, you want to have business management covered on a professional liability policy. It would usually be done by endorsement. I mean, this is a little out of my area, but you know, you would be able to get a manuscript endorsement out of a non-admitted carrier, and perhaps something like business management or you know, some different type of trustee coverage would be a lot easier to do through a non-admitted carrier. You're going to pay more money, but it's, you know, what's most important will have coverage. So they serve a purpose. Excuse me. They serve a purpose in the market without question. The non-admitted carriers, for many reasons.
Yeah, and of course I understand that role, having dealt with them in the marketplace for a number of years. So it sounds like they have a place, and they add to the capacity of the marketplace to make sure that folks are insured, especially when we're telling folks in California about disclosure as one incentive to make sure that folks are insured. They have a market to turn to, even with a more dense claim history. Is there any sort of disclosure that you as brokers do, or that the insurance company does on its policy to make it clear in writing that this is a product that is not as regulated as an admitted product?
The Department of Insurance mandates that for every non-admitted policy sold, the broker must get a D1 form, I believe is what it's referred to, and it has to be signed. It's all in bold, large type, stating that this is a non-admitted carrier, and I don't have the wording with me, but you know, giving well-disclosed notice to the insured. And surprisingly, insured sign that thing quicker than you can imagine, and send it back in. They don't really worry about it.
Yeah, right. Okay. And in terms of just as an example, a solo practitioner coming along to a broker in California who says, you know, I'm done with my last policy, or I need to get a new policy because I haven't had one. Is it typical for a broker to quote both admitted and non-admitted products to give them, the client, a range of options?
Often, depending on, you know, the broker and what relationships the broker has. If it's a new program that, you know, is perhaps offering brokers a significant incentive. They may do that as a way to present a broader picture to the insured. If it's a clean insured, we would never do that, our agency. It would just be convoluting the picture or making things a little bit more, confusing.
Plenty of great choices with admitted carriers with great reputations in California.
Right.
to
There's
afford.
right now an abundance of those that I wouldn't recommend somebody go to a non-admitted carrier unless their situation was unique, where they needed manuscript endorsements and things.
Okay.
Again, though, on this subject here, if we were talking 15 years or 10 years ago, there'd be a whole lot less carriers in the market, and rates would be a lot higher. So when we're discussing this mandatory coverage, we've got to remember that. Because right now, it's easy to get coverage in California, but 5 years from now, it might not be.
Well, it's a great, yeah, go ahead, Joanne.
Actually, we were on vacation, but we reviewed, the Daily Journal used to publish a magazine, and they had a professional liability insurance guide every year. And we went back to 2001 to 2015 when they stopped publishing. And for those years, it showed a very robust market every year. So I think you may have to go back a lot farther than that to find anything that would be an issue. We didn't go further back than that, but for the past 18 years, it's been a very strong market. There's been a lot of options.
Yeah, it's great to have that perspective, just so everybody understands. Those of us that have been in the profession, 30 plus years, we've seen it go up and down. We've heard things thrown around like hard market and soft market. We know from the history of the assessment of mandatory malpractice coverage in California that going back 30 years ago or more, there were times where there were no options or one or two options in California. Out of that sprung a lot of the legislation that still provides benefits and advantages for California policyholders today. So sometimes those tough times spawn some legislative responses that we're all glad we had. We've been fortunate over the last 15 years or so to have a fairly steady, predictable, somewhere right down the middle, hard soft market with plenty of capacity available. I think the thing to consider, Dan, which was your point, which is a great one, and that is, but what happens if something there's a crisis of some sort, and California has been through that crisis with lawyers 2 or 3 times, with doctors 2 or 3 times, and the reaction to that is usually something fairly dramatic. The seas are smooth right now, and there's plenty of good wind supporting a safe journey here, but
it obviously remains an issue where either it's IP, trademark, I understand the difference, are charged a higher rate or not written at all, at least with respect to patent. Maybe the way to look at it here, though, is to relate this, Joanna, which I think you were sort of getting to, is to relate this to the small practitioners that are doing, maybe some IP, but maybe more trademark work for small businesses, and whether those lawyers are in a position to have available, affordable coverage. And this is one area where maybe there's some challenges there. So it's a real issue.
I have a question, and just let me know if this is not the right time for the question. But this is just kind of a more broader question. What is the thinking around whether or not mandating coverage will expand or contract the market or the number of providers in the market? Because I hear when you responded to Randy's question about potential trends in the out years, or what the most significant potentiality might be out there that would impact the number of providers in the marketplace. You indicated that it was the interest rates, which suggests to me more of a macroeconomic set of factors that impact the number of providers in the marketplace. But my question is, do we believe that mandating coverage would in and of itself impact the availability of providers? I have that question. Do we have any history or do we have any information to help us answer that question based on mandated car insurance? And then I know more complicated, but mandated health insurance. So if it's not the right type.
No, it's a good question. I think now would be, I don't know if I could be, concrete or specific in answering it, but my thinking is that the market will, if insurance is mandated, it would probably increase the capacity. My thinking is the insureds or the California attorneys that don't carry malpractice insurance now because they feel very comfortable that they're not going to be sued, those will be excellent risks in all likelihood. The ones that are not carrying it because it's too expensive, it's still going to be too expensive, or it's still going to be very expensive for them. They're just going to have to pay. So I think the pool will become a safer pool as if it's mandated. So that should maybe even tend to lower rates a little bit at first.
If I could add to that, when you look at other states that are looked at this issue, and Oregon is adopted, whether or not there was adequate availability of coverage is an issue. And Oregon took care of that by creating their own fund. So it's only one part of the question. If we mandate, if we do mandate, would it be something we have to provide ourselves? Or do we have enough carriers out there to take care of it? Is this an issue as far as availability? So we're trying to determine if there's an availability issue in California as just a foundational question before we move on to, if we mandated, how would we do it? So it's just one of the many pieces of the puzzle.
I think it's a great question, and both your responses were spot on. It sort of slops back over to the discussion we had in last meeting about the open market model. If we went to an Oregon captive fund model, there'd be one fund that would service all the premiums and claims handled within California. That's a topic that's coming up soon. But what we've heard today so far is that there's plenty of carriers here right now. If we were going to a true open market situation here in California, there'd be a number of carriers admitted, not admitted, to think about whether the legislature would be interested in having an open market model that would include not admitted carriers, but I'll leave that one for another day. Let's assume they're all in the pool, then your viewpoint is plenty of insurance available, the rates would actually come down a little bit. There might be, a subgroup with a more dense claim history that would have to fish around a little bit more, but other than that, there's plenty of capacity in an open market model of mandatory insurance in California. Is that correct? Is that okay? Heather, you had something before?
No, it was responsive to Joanna's question about IP claims, but I think others answered.
Okay, great. Judge?
Well, I was just wondering though, do we really know if there's the availability for the estate planning patent prosecution high-risk claims? Because there does seem to be a lot of availability in general, but if there are a couple of high-risk areas and nobody's going to cover them, then maybe there really isn't much coverage available.
Well, I think that's what we were getting to, because, again, primarily the issue here that we're studying, or the context of the issues that we are studying here are most dominantly felt by the sole practitioners and 1 to 5s, the big firms that have big policies that ensure all their lawyers practicing in that arena. They're not the issue here. The issue is the 1 to 5s and the pretty significant percentage of the 1 to 5 that don't have insurance now, getting them into the deep end of the pool with everybody else. And the 1 to 5s do have estate planning practices. That's a large part of their practice. They might do some IP and small-time trademark work. And if that's the case, are we now, if we mandate insurance, are we putting them in a situation where it's not affordable, or the rates are too high, or it's not available at all? I think that's the question. Okay.
Just as a note to your question, Leah, Oregon, if you look at their premium history, because they became the captive carrier and they took all the risk, their rate has consistently gone up. Their rate is whatever it is right now, but it has gone up over the years. And to Dan's point, if you insure all those people that are uninsured, there are going to be some great ones who have not had claims, but there are going to be some bad ones too in the mix. And so you change the complexion of the pool you're insuring. So the rates may go up astronomically in some areas and down in others. And then depending on the claim of the day, so your areas of practice right now are business and estates and plant, those prices are up, but now plaintiffs are down. Whereas before plaintiffs' prices were high. And so it's very unpredictable in terms of the lawyers being sued, the areas of practice. And it may well be, if you mandate insurance, then no one will want to be here because they're going to assume a lot of bad risks. It may not be profitable, and you've already got the DOI regulating profitability, and then you've got to take all these risks. As a carrier, you may not want to do it. Or, opposite side, you may say, hey, this would be great. I'll come in and test it out. But they will have the option to leave or stay, which brings you back to the insurance cycle. And to Judge Perkins' point, right now you have high areas of risk that are expensive to insure, but on the flip side, you have low bono or pro bono that don't want to get insurance because any insurance is too high, because it doesn't take into consideration their area of practice that it's a lower risk. So you have both ends of that spectrum.
Maybe we should talk about affordability then next.
Yeah,
Yeah.
that's your bailiwick.
I want to get to Scott. Scott?
So I think a lot of the premise here we were talking about that we're currently in a soft market. How does this analysis change if we get into a hard market, which it sounds like we will eventually? I mean, it sounds like it's pretty cyclical. I mean, is that going to just exacerbate how hard it is for these people who are already choosing not to get insurance? I mean, are there concerns that it'll be even harder for those people to get insurance? And so will the open market model work in a hard market?
That's what I keep on mentioning, that we're looking at a moving target here, because when it's a hard market, these prices can easily double for a lot of practitioners. And that's where I think there could be a real problem to the profession if we mandate the insurance. I saw back in 2000, pricing was probably 40–60% higher than it is today. So it could happen very easily if there's some change in the law or interest rates or changing in the pool maybe, of insurance. So that's something I think that we need to consider when we make our recommendations on this.
Does mandatory insurance, either on an open market basis or a captive fund basis, fix any of that? If we were to have the legislature say next year we're going to have mandatory insurance on an open market model,
would the marketplace through those carriers still be subject to the ebbs and flows of the broader economic trends, or the dynamic nature of the risks in IP, business transactions, plaintiff work? Does any of that get fixed with mandatory insurance as opposed to the open market model that we have now?
I don't think so. I think it would pretty much stay the same. I mean, unless if the state bar was to mandate that any carriers that were going to participate in California, insuring California lawyers, had to take on more risk. In other words, CNA, if somebody does more than 10% intellectual property, we don't write that firm. If somebody mandated, okay, you know, if they do up to 50%, you've got to take them as an insured, that could change the dynamics of the availability of insurance. I mean, the carrier might say, well, forget it, I don't want to do business in that state. So,
Yeah, sort of like mandating coverage of pre-existing health conditions.
Correct.
Exactly.
Yeah, this is kind of I don't want to preempt my own presentation. But there's two ways to look at that, I think, what you've raised, Dan. One is, you're required to pick up a particular insured or risk, which is kind of the mandate operating on the insurer. The other is the California Fair Plan model, right, which is to say you're all required to contribute to a pool to the extent you're an admitted carrier or you participate in this market. And that pool is going to pick up low bono, pro bono people, higher risk people.
Canadian model.
Yeah, that's just another way to look at it, and that's kind of what Fair Plan is, I guess, fires on everybody's mind these days, but that's essentially what that model would be.
We have a guest speaker today, Professor Felmuth, that's going to join us at 1:30 that will hit on some of these topics and maybe different ways to accommodate some of these issues about folks that aren't insured or insurable, a fund to set up to cover clients that are somehow victims of malpractice that would be contributed to by sort of a fair plan idea. I don't want to steal his thunder. His testimony has been provided to us in written form. I hope you had a chance to take a look at that, but if not, you'll hear him speak at 1:30 today. Those are because there's lots of different ways to look at this. So it sounds like, just to summarize a little bit, the state of the market, sort of like the state of the union is good. The state of the insurance market, the lawyers, professional liability marketplace right now is pretty healthy, pretty diverse, pretty robust, barring some change in the overall economic trends. It sounds as though the players that have been there for many years and all the opportunist players that come in and out of the marketplace and feed out of the pool, that seems to be, at least from our best way of predicting, what we'll see for the near future.
I would agree 100%.
Yeah. Okay. Can we switch to affordability? And because it's all well and good to have this coverage, and we sort of hit on it, or the capacity in the marketplace sort of hit on it. But let's talk about affordability. What can, focusing on the 1 to 5s, what can the 1 to 5s afford these days? And the groups within the 1 to 5s, low bono, pro bono work, for example, is that something that's affordable? And then the bigger question at the end of the day for your group is, does any of that get changed in a mandatory malpractice insurance environment? So can we talk about affordability?
I don't know how many of you remember the survey that was done, and some of you weren't here to hear the results of that survey that we did of attorneys this year regarding these issues. The biggest takeaway that I got from it was that of the solo practitioners, 71% who didn't have insurance said the reason they didn't have insurance is because they couldn't afford insurance. And of the firms that are 2 to 5 attorneys, it was 63%. They could not afford it. And if they could afford it, regardless of their annual income, they They decided $1,000 a year is what they could afford. In California, as we all know, we're dealing with extremely high housing costs. Law students are coming out with huge student loan debt, and healthcare is very expensive. A lot of small firms and solo attorneys don't make a lot of money. I don't even make it up to buy a house in San Francisco. This median income is too high for that. It's, with all the other expenses and the high cost of doing business in the state, the price of malpractice insurance really is a real issue. To some people, $1,000 a year may not seem like a lot, but when you're a small firm or solo practitioner and you're doing work for small businesses, you're doing work for the average person on the street that needs help with a small matter, you're not making a lot of money, and you're providing an essential service. And so it's a very challenging issue to deal with. We talked during June 4th about the pro bono attorneys and low bono attorneys. I guess there's an option for some pro bono work to go through a legal services group to get their insurance for that work, but a lot of attorneys that do low bono, there is no recourse, there's no cheap malpractice insurance. Now, the size of the claims, if there really are going to be claims, would not be large to begin with. Perhaps there's less incentive to even bring a claim into those circumstances, but you're making so little money as it is, if you have to get malpractice insurance, it's more likely that those services simply won't be provided. But the survey that was done, that was presented already, is very, very helpful. As far as annual income, what attorneys thought they could pay, those that made less than $50,000 a year, 57% said they could pay nothing, and 35% said they could pay up to $1,000. That's a huge majority. Between $50,000 and $99,000, 57% said they could pay up to $1,000, and 36% said they could pay nothing. From $100,000 to $149,000, it was 54% said up to $1,000, and 29% nothing. These numbers, as far as up to $1,000, stayed fairly consistent, even for those that make over $500,000 a year. Not something I particularly understand, but that was a fairly consistent response. I don't know that there are extremely inexpensive malpractice insurance policies available. I guess my practice is not the best one to go on, since I do intellectual property entertainment law. I paid $1,200 a year, and it's one of my larger expenses of doing business. For doing really small matters, maybe contract negotiation or trademark filing, there's no way that if a mistake would be made, the damages would exceed $10,000 at most. But I can't get a policy that low, obviously. And since I'm a law corporation, I'm required to have a policy of $50,000 or $100,000. I can't get a policy that low. I have to do $100,000, $300,000. That's the minimum I can get. So there's a real balancing act that small firms and solo practitioners have to make when they make a decision to do this. If they're doing extremely well in their practice, it's a much easier decision than making plenty of money. But with all of the costs of doing business and living in California, it's a real issue for the group of attorneys that we are most concerned about, and that's the solo and small firms.
Exactly what Joanne just said. The group that we're looking at are the small firms. I mean, over 5, I think we're in agreement. They all do carry insurance, and they're not the issue here. It's the people, the consumers that are damaged by the small firms. And I agree with everything Joanna says. For one, I'm shocked that you were able to find a policy for $1,200.
Yeah.
All candor, I mean, I've got some rates here to go over. I am embarrassed to mention what typical family law or personal injury attorney pays us with CNA.
I'm a good shopper.
Yeah, very good shopper. I want to take you out next time we go to the store. But those are the people that we have to be concerned with from the legal side of the ledger. It's not the larger firms that can afford this stuff, but it's the guys that are doing good for, the little guy in the street. And if we, make them not want to do that work or decide they're gonna do something else, are we really helping the profession and the consumer? So this has gotta be weighed, into the picture. I mean, to give you an idea on what CNA charges, right, from an affordability standpoint, a firm that does all family law for limits of $100,000 per claim and $300,000 in the aggregate, the annual premium with prior acts coverage would be $2,500 a year. They take that up to $250,000, $500,000, which is what we have used as our minimum limits for the last 20 years in California. That premium is $3,550 or $3,500
Per attorney.
per attorney. I'm looking at I'm just devoting this to the small 1 or 2 size firms. I mean, the rates change when you get larger, it becomes less per attorney, but just focusing on the small, the non-insureds that we see nowadays out there. If you go into estate planning, wills, estate planning, probate and trust, that $2,500 figure for a family law attorney is up to $4,854 because we've taken rate in that area. Kathy, Lawyers Mutual doesn't do it that way, and I'm not saying which is the right way. We've both been doing it a long time though, so it's working a little of each, I guess. So that rate is now for us similar to what plaintiff personal injury is, which would be $4,865 for 100, 300. So when we're talking $1,200, the family law attorney that's helping, this poor families, where there's been some abuse and terrible situations, I don't know where they're gonna get a policy for $1,200.
No, I'm working part-time, and then that's probably why,
okay, well,
which was also, it was not easy to find a policy for part-time.
Yeah, but I mentioned this only to, I think in all candor, the premiums are gonna be higher than $1,200.
Yes. Yeah, it took me a long time to get there, from when I was doing it full-time.
Right.
I was paying probably $3,500 a year. It's a lot.
Yeah, no, there's no question of that. But, I mentioned earlier, just talking, as we look at these, and I do appreciate that they're a lot of money, and I had premiums years ago myself, and it was a lot of money. But, you talk about a construction company, somebody that's doing contracting work on all of these homes that have been damaged by fires out here, and a roofer, and for their workers' comp insurance, pays $60 for every $100 in salary he pays. So your lawyers pay a very, very low cost for their workers' comp and a very low cost for their general liability. They certainly wouldn't get a lot of sympathy from people in the construction business on the way insurance works.
I'd be willing to bet a lot of those roofers make more than lawyers.
Well, a lot do and a lot don't. I mean, there's a lot of roofers that are struggling, and there's a lot of attorneys that are struggling. I mean, it's, there's some successful roofers, but in general, you would think that an attorney would make more than a roofer, right? But they don't have the.
It's a misimpression.
So, that's perfect.
I have a question on the probate. I have a question on the probate and estate planning rates. Is that ever broken down individually, like in the IP area? Because there's a lot of big dollars in estate planning, but in the probate conservatorships and guardianships, which are a real important public function, there's a lot of work done for little or no compensation.
Yeah, great question. CNA, we just started, right when I retired in February, to use a supplement. I thought my timing was impeccable because it means a lot more work. But we are now sending supplements to all of our, we call them WEP, wills, estates, probate and trust attorneys. And we recognize, the litigation people there maybe are going to have, they're not going to be as much exposure as the guys that are drafting the trusts and the complicated, trust documents. So we're trying to ascertain that, and it will take a few years, though. With insurance applications, if you put too much information on the application to, you're insured, they gripe like there's no tomorrow. So you try to keep it simple, but then you have a situation like this where finally now the ball's in our court. We can ask them, and if they don't like it and they want to take their business elsewhere, we're not going to cry about it. So, okay, thank you for your question.
So is there a problem? Is our insurance too expensive in California? Whether you take into account, the other expenses that we all bear in California, living in popular places, is it too expensive for a sole practitioner or somebody doing pro bono and pro bono work, or a one or two person shop that's doing mostly wills, estates, probate, and trust work, and maybe some business transaction, which is also high in the scale of exposure and risk, and a two-person shop doing wills, estates, and trust in California looks like they're paying $10,000 a year. That's a big number.
Yeah.
To a firm, especially if they have sort of a challenged, rate impacted practice where it's not highly profitable.
Personally, I think it's too expensive to mandate, and I don't think these figures are unreasonable. And this is a soft market, and times have been good. These figures could very well be higher, and if they are, you're going to put a lot of hurt on a lot of sectors of the legal community. These rates are higher than anywhere else in the country. Almost 40% higher, 50% higher than New York and other big states in the East Coast, which is surprising to me. I would say there's a better way to protect the consumer, and that would be with an adequate disclosure, rather than put this onus on every attorney that they've got to pay this $5,000 or whatever it might be. An attorney can make a mistake and have one claim, and those figures could be a lot higher. Somebody goes off to law school and they devote their whole career to the legal profession. You hate to knock them out of the profession because there's nothing.
I'm worried about the access to justice impact on mandating it with the premiums as high as they are, because it's difficult enough for a middle-class family to get legal services. Most, even lower-class family doesn't have the funds. It's pretty much impossible. And if we mandate it, it's going to either drive attorneys away from that work or make them raise their fees to cover the cost, which is going to make the problem even more difficult, more challenging to address. So that's my concern about mandating it with the premiums is high.
Okay, so there's a concern that given these rate structures, at least what we have right now, that if we were to tell everybody in California they got to buy insurance, that's going to become something that's not affordable by a significant major fraction of the lawyers in California in the 1 to 5 group.
A portion, I don't know. I think that survey, people maybe didn't express exactly how they just they don't want it, so they're going to say they can't afford it. I don't know how accurate.
Well, there's other reasons. They gave other reasons, but that was by far the largest.
They can't afford it.
Right.
Yeah.
So
Some of them think they don't need it. Others can't say they can't get it, but by far and away the largest majority said they couldn't afford it.
Okay, so we've got maybe 30% of the solo practitioners in California, at least as of the last count, that aren't insured at all. And the reason 71% of them say that they don't have it is they can't afford it. So does mandatory insurance make it better or worse? We'll leave that one open for a second because I want to get to heaven.
As I mentioned last time, I haven't drawn any conclusions yet. I have no conclusions, but I can share my anecdotal view, and I did share this during the last meeting. But myself, and I assume probably you, Randy, and Glenn, and Scott fall in the same category, but we've received many dozens, if not hundreds of calls over the years of people who do not carry malpractice insurance and need a defense in a legal malpractice case. So I think, probably the collective experience of the four of us would be telling, at least on an anecdotal level. And the one thing I can say, and maybe only a certain type of uninsured person is contacting me, but in 23 years of practice about that, I don't think I've ever had anybody contact me and say, I don't have malpractice insurance and I'm engaged in this pro bono practice and I don't carry the malpractice insurance because I'm providing access to justice services. I've literally never heard anyone say that, ever. All the people who contact me for representation who don't have malpractice insurance, they're usually engaged in some type of just normal practice and they've just made certain financial decisions. A lot of them didn't think they'd get hit with a claim. The only reason I mention this is I'm certainly not saying I'm in favor of mandatory malpractice insurance, and there's a good chance I may not be, but I just don't think that, my gut feeling is that there are not a whole lot of people out there, such as the people we heard from during our last meeting, who are engaged in true pro bono, low bono practices, who don't carry malpractice insurance and fall within this demographic. So I just I think there's a lot of people who don't carry legal malpractice insurance because they've made certain types of decisions in their lives, and probably the vast majority of the people who contacted me for representation when they didn't carry malpractice insurance could have afforded it. In other words, they could have rejiggered their resources, but they just determined that they didn't want to do so. So that's just my anecdotal experience. I do think it's a serious issue. The people that we heard from during the last meeting, and that was the meeting that myself and my colleagues put on, and those are people in the true pro bono, low bono worlds. I mean, people who are really out there trying to ensure access to justice. I do think it's an issue with regard to those people, but I think there's a massive demographic of people who don't carry insurance, who don't carry it for other reasons, just because they don't think they'll get sued or because they've decided to put their resources elsewhere and probably could afford it.
Can I follow up on that?
Of course, go ahead.
Interesting that if people are contacting an attorney to defend them, that means they've been sued and there is recourse in the courts. And if they do have the finances, there's something to collect against there. So, while it would be great to always have insurance, the fact that they don't doesn't mean that the clients are necessarily hurt. That the attorney doesn't have somebody to defend them, or that they can't afford somebody to defend them. I'd be more concerned about the comments that attorneys won't take a case against an attorney unless they're insured. And these are all anecdotal. We don't have any numbers for any of these things to really see which way they swing. I'm not going to have a hard time with the judgment that people. Maybe your experience is that people are just not making good choices with their finances and they're choosing to spend their money other ways. But in the world I live in, there's housing, healthcare, groceries. I mean, these are basic living issues. And I know a lot of solo practitioners who have very, very modest living. So I don't see people out there spending lavishly instead of buying malpractice insurance. Maybe it's a San Diego thing.
It's purely, what I said was purely anecdotal. There's very poor statistics out there, there's very poor information. So I appreciate Joanna's points. I think they're really valid points. But the one thing that's true, and Mark Abelson is not here today unless he walked in, but Mark Abelson did tell us, and certainly it is my experience, that the plaintiff's legal malpractice attorneys won't take the case unless there's insurance. That's a well-known fact in legal malpractice law.
How does that fit with people calling you for defense because they've been sued and they don't have insurance? Those two don't jive to me.
Yeah, well, they don't know that when they're sued, the person who sued them doesn't know if they have insurance or not. And when the plaintiff's attorney learns that there is no insurance, oftentimes they won't continue on with the case.
They can't. That would be completely inappropriate. You have to go to the court and get released from the case. Can you? I have other issues with that, obviously.
Yeah, I mean, my experience is that most of the time there are ways for a plaintiff legal malpractice lawyer to find out if the defendant lawyer has some coverage or not. Sometimes the client goes back to say, go back to your lawyer, or if you're still friendly with him, and ask them if they got it. Maybe they disclosed it, that they didn't have it, and it's out there in writing at some point. I agree that there's a lot of dissuasion that goes on when you find out that there's insurance available. And you could usually find out in some way, shape, or form. And of course, it's discoverable once you get into the case. I agree that raises ethical issues. I'm going to take the case and represent you. No insurance, sorry, I'm going to jettison. That's a problem. We all agree with that. But usually a plaintiff lawyer in that position doing their due diligence to figure out a way to get that information up front in some way, shape, or form. Connie, you had an observation.
I was just going to make two comments following up on what Heather said, and just since she was speaking anecdotally, the only two things I thought of when she was speaking was that one, it could be that these pro bono attorneys are not being sued, which would lead to not requiring them to have the insurance if it's not necessary, because part of our I think part of our job here was to decide whether the public needed us to require this insurance. And so that was one thing. And then the other thing was it could, I think this is probably what you implied by saying it could be who was coming to see you, that, people such as Joanna was describing who are struggling may just not be coming to claimants for help.
That's true.
They're either, if they're struggling for money, they're either going to represent themselves. If they truly can't afford insurance, then they're not going to go to a top tier law firm for help. They're going to either go to a low level law firm, a friend, or represent themselves. They are attorneys, so those are just my comments.
Because unfortunately so much of the discussion, and although I haven't been at very many of your meetings, I have a briefly reading with staff, so I get a sense that there's a problem with data and information, and that we are kind of limited to a lot of anecdotal observations. And so I'm wondering if you all have discussed means testing any kind of mandate. So for example, right now with the licensing fee, we have the ability to scale the fee based on your income, and we require an attestation of income. In other circumstances in the state bar, we require documentation of income. It could be, there are many different ways that this might be approached, a waiver of the mandate based on income, or a subsidy of the premium based on your income, and that would be achieved. I know I read Professor Feldman's testimony or report for the working group that he suggested an increase akin to the client security fund. That would be a mandated fee that would form a pool that could then be used perhaps to subsidize the premium. So just wanted to ask if you all have thought about that and suggest that there is a way to slice and dice this in a manner other than either or. You could have a graduated approach to a mandate that would take into account those attorneys that are truly providing access to justice services. I too am skeptical that that is the majority of this population, but again, that's only my own anecdotal sense as well.
Well, it's a great comment, and I agree. But let me broaden that idea a little bit more. Here's what the State Bar Act says. It says, protection of the public shall be the highest priority for the state of California and the Board of Trustees in exercising their licensing, regulatory, and disciplinary functions. Whenever the protection of the public is inconsistent with other interests sought to be promoted, the protection of the public shall be paramount. That's the law of the land. That's what the legislature tells us, and that's what we as lawyers have to follow and pledge to support. So we talked a lot about, lawyers can't afford this, or it's a lot for a lawyer practicing this area or that area, but let's look at the other side of the coin, and that is, do we have victims out there that are going without financial recourse, victims of legal malpractice that are going without financial recourse because there's no insurance coverage. Insurance coverage would find it would be an easy one-stop shop for that. In many circumstances would be a remedy for an aggrieved client who was damaged by an attorney's malfeasance. And yes, I think as a subtopic of that, and Professor Felmus will talk about this a little bit, and that is for those attorneys that are truly disadvantaged or burdened by a higher or unaffordable premium structure by mandated insurance, perhaps there's a way to calibrate that that's consistent with the type of practice that they have. I'm not exactly sure how to do that. Professor Felmus may talk about some of that, but that is a way to perhaps deal with the issue of those lawyers that have a rate challenge practice that are also performing for the greater good, where that might be accommodated in some way. So doesn't the mandate of lawyers' professional liability insurance fulfill the idea of public protection? Isn't that the solution? And if so, why are we in California not fully in favor of this, so that every victim of malpractice has a place for a remedy?
We did have a discussion about this at one of our earlier meetings, coming down to what problem is it that we are trying to fix. We haven't really identified any problem, and unfortunately we don't have data to support a problem. And because of that, we're kind of fishing in the dark as far as that issue. We can make assumptions that there are clients out there that are not able to recover, but we don't have any facts to support that. So without the data, it makes it really hard to figure out what the problem is we're trying to fix, so we know exactly how to fix it.
Okay, well, for your committee, what you would be looking at is if it is mandated, depending on which model, and there's a big difference between an open market model and a captive fund model, will it be affordable to lawyers to be able to purchase it, and will it be adequate for clients to be able to have some remedy if at the end of the day they are victims of a lawyer's malpractice? That's a pretty significant piece of this puzzle. And does mandating insurance do more good than harm?
I don't think we looked at that issue. I think we were limited to just the current state of the adequacy affordability of acquisitions.
Okay. And I agree. But we're going to need to transport ourselves into the future, I think, and crystal ball this as best we can to say, okay, what if this one or the other model is put in place? Is it still affordable? How does that change things, or does it become unaffordable, or does it result in a more competitive marketplace, once we have all these uninsured lawyers who are on balance pretty insurable? Does that bring the premium structure down for everybody, and so somehow we've ameliorated the unaffordability issue? I don't know, but we need to sort of crystal ball this a little bit, I think. Scott?
Going by the mandate of the State Bar Act, I guess I look at it as, I don't think you can seriously dispute that if you mandate insurance, some lawyers are going to leave the market. The question is, how many, what's that pool look like? And based on the answers to those questions, I think you'll have a better sense of whether it's better for the public or worse for the public that you mandated insurance. And I think, taking off on what Joanne said, I don't know that we have enough information to ever be able to make, at least in the confines of this group, that determination. And so we can just as easily be doing more harm than good to the public if the number of people that drop out of the market ends up being higher than we guessed it would be, because that's all we're doing is guessing. That's what scares me a little bit, is that we just don't have the information to answer these questions. We're all able to identify the questions, but we've had a real hard time coming up with answers to them.
Okay, so it's sort of a balancing. In other words, if we put in place mandated insurance, are we doing more harm to the profession while we're providing a benefit to the aggrieved clients, or
There's also harm to clients potentially with attorneys leaving the market.
who vacate the marketplace? I agree. Heather?
I'll just say, I know I'm giving a bit of a preview here, but Randy also previewed it in some of his comments at the first meeting. But I think everybody here who's not, well embedded in the legal malpractice market is to be very interested in hearing from Canada. I mean, Dan Pennington from Canada is the best speaker I've ever heard on the topic of mandatory malpractice. He is excellent. And he runs Law Pro now. He's the CEO of Law Pro, which is the entire Ontario region of Canada. And they mandate it, and they have a fund. Their fund is incredibly well run. They ensure that every single person who's the victim of malpractice has recourse. And they're also so good, and it's such a unified system that they're easily able to weed out the frivolous claims. And there are a lot of frivolous malpractice claims in the state of California, an overwhelming number of them for sure. But if you want to see how a really, really well-run program ensures the lawyers aren't forced out of business and the public protection is served with regard to those people in Canada who have experienced malpractice, I would urge all of us to listen very carefully to what Dan Pennington has to say. And I think he's coming on the 9th, is that right, Glenn?
Well, it's
November 9th?
No, actually, our meeting is on the 13th. And unfortunately, that is their annual review for Law Pro. So it'll either be Dan by video conference, or it might also be Sue Forbes, who's the head of the British Columbia program.
Okay, yeah.
But just to build on that idea, I think I know we're all concerned about the anecdotal piece. I'm concerned about the anecdotal piece. How do we fill the gap? We should be asking those questions of people who have mandatory programs like that run captives. What is the interaction with the people with the small claims, the people who can't afford to go get a lawyer? How do Oregon can also fill some of these gaps, that they can speak to the issue of the people who have the $3,000 claim and how they handle that. The frivolous claims, I think that's an important issue as well. But that's a piece that might be missing for us, that they may be able to kind of help us, fill out, which is, what does it look like and it's an access to justice issue. What does it look like from the standpoint of people who really can't afford to go out there and hire a plaintiff's lawyer like Mark Abelson to pursue their claim?
There perhaps is even a more basic way of looking at this, stripped of all the affordability and impact on the lawyer marketplace and all that. And that isn't it just the right thing to do for lawyers to insure themselves? I mean, we do it with car insurance. It is the right thing to do. We don't want people out there to be victims of a negligent driver without some means of redress. That's just a given. It is a given. It doesn't need to be in the Constitution. It just is common sense. So, while it may not be something that you can get your arms around in terms of identifying a problem, or these people in this county were left penniless because of this lawyer's malpractice, anecdotal information versus something that's verifiable, forget all of that. Let's just insure ourselves because it's the right thing to do. And then we'll deal with the idea of the disparate impact on the lawyer marketplace, because we don't want to, at the same time, by mandating it, force lawyers to leave practice because it becomes too expensive for them to bear that piece. Perhaps there's a way to calibrate that so that those lawyers are still providing that service to their clients. It also, I'll observe at the same time, not advocating, by the way, I'm just being the devil's advocate, but at the same time, there are precedent for this.
Canada has dealt with it, Oregon's dealt with it. There's still lots of lawyers out there that are doing wonderful things that can afford the premium every year, especially when it builds up over time. It's like, I'm gonna become a lawyer, I'm gonna choose to do this sort of practice, I gotta pay my way every year for the greater good. And, you know, yeah, it might be a shock in year one, but over time, you know, you sort of get used to it, just like higher taxes or property taxes or whatever. It's just the cost of doing business. Great.
I have a question. Dan, you had mentioned that the rates on average here are about 40% higher than New York.
Yeah.
And I guess when I first heard that, I thought, well, we're California, we're always more expensive with regard to any sort of product. But then I still don't have a good sense of why that is. Why is it so much more expensive in California?
Californians, for whatever reason, they tend to be more litigious. More claims are filed out here against lawyers than even in New York. That's the only thing that we have been able to determine is the reason. I mean, the complexity of cases are very, very similar. There's more of a code of ethics. Attorneys don't sue attorneys in New York like the old Wild West days. We have not, and I say we, meaning my agency and CNA, have not able to pinpoint the exact reason. But along those lines, and what Leah had asked about with the salary, graduated premium type level, CNA did come out with a program, and they would be willing to reintroduce the program if the recommendation is accepted as mandatory insurance, of offering what they call the value plan. And that program had a cap nationwide. First it was $35,000. I think they realized that was a little bit too low, and they raised it to $75,000. Where if you qualified, if you practiced in certain areas like pro bono or low exposure, public interest type law and all of that, you got a much, much smaller premium. I mean, a premium of less than $1,000 to start with. And they elected not to offer it in California. With our blessing, we thought that it would be, just an astronomical loser in California, offering such low premiums. Even to attorneys that said they only did this very low exposure type work. So other parts of this country have it, and it's not been usually profitable, but it's still there.
There's other programs that carriers have, including MIC for new law school graduates, those entering into practice, which is a steal, frankly. It's been a great program for a number of years. LMIC started it, essentially. So there's ways to do that, whether it's based on being a new lawyer or based on having a certain type of practice.
Yeah.
And just to respond to Greg's question a little bit, Scott, you were going to say this, but the expenses that drive the premiums in California too. The cost to defend a claim is higher here.
Yeah, right.
The only other thing I would say is I think New York law is more favorable in defense than it is in California law, and the way it's applied is more favorable, and summary judgments are granted a little bit more frequently. And so I think those are factors that come into play as well. And I might disagree a little bit on whether or not they have that gentleman's agreement in New York as far as...
You're probably right.
But I think that's a lot of it. I think is driven by the way the law is built, or the liberal. Both states are somewhat liberal, but I think New York has more has better laws to defend the attorneys.
And remember, as a comparison, New Jersey is not so kind to lawyers. They have a recovery of prevailing party attorney's fees and an endless statute of limitation, which makes it very expensive. And that was a major factor in New Jersey's ultimate recommendation to not elect mandatory malpractice insurance there, as we heard at our last meeting. So maybe California more is aligned with, for different reasons, with New Jersey, because the big concern there was it's going to cost a lot of money for lawyers to now have to purchase insurance, because it's a state with higher exposure than most. We have higher exposure than most in California because of the types of claims and the exposure and the expenses. Scott.
Yeah, just want to respond to one thing you mentioned, because we've heard this analogy a lot about we make our people that drive cars get insurance. completely different situation, because when I get on the freeway, I have no control over who it is that hits me, right? And so that's why you have insurance. With a lawyer, and this is somewhat foreshadowing our next session next month with disclosure, with a lawyer, you can decide ahead of time to only hire a lawyer who has insurance if you have disclosure rules. And so that those concepts go hand in hand. You can't do that with cars. I can't, oh, I better drive a little further from that car because he's got a sticker on his window saying no insurance. But I have that ability with a lawyer. And so I think, sort of letting that market play out and having people know, look, I may want to sue my lawyer. I may be afraid of not being able to collect. So I'm only going to hire that lawyer who has insurance. That's something I think that all gets worked into this analysis as well.
All right, good. Fair enough. Well, forget about drivers and what about pharmacists? What about doctors? What about a roofer who's got a...
Exactly true, though, because your ability to exercise your free market power is very dependent on your income level. So the kind of people that we're talking about and worried about are reportedly these attorneys who provide services at a relatively low rate to low and moderate income people. So those low and moderate income people do not have the same ability as perhaps many of us sitting around here to make decisions to hire this lawyer versus this lawyer based on whether or not they have insurance. Because they don't have the means to make those kind of choices.
But if that's the pool we're concerned about, and I agree with your statement, but if that's the pool we're concerned about, then I'm even more concerned about the mandatory insurance, because those are the very people we think may drop out. And I do want to say, I think Connie mentioned this before, there should be no illusion that those people don't get sued for malpractice. I think they're more likely to get sued. I think pro bono clients, if anything, are more likely to go out and sue their lawyer. Now, the claims may not be as big, but they're very likely. They often will do it without a lawyer. They'll do it, on their own, pro se. And so I think there's a very real risk for those people that they're going to get sued. So, it may be that this graduated scale helps that situation, but I think if we're going to focus on that population, then I think you have to recognize that these are the people who are most likely to drop out if they're required to spend, $4,000 a year on insurance.
And in the non-insured population of solos and two-size firms, they're not predominantly low pro or pro bono attorneys. I mean, we see applications year after year from the same attorney just shopping that does plaintiff work, and he doesn't buy the insurance, not because he can't afford it, because he thinks that he won't get sued if he doesn't have the insurance. So that's not much of a protection for the public.
Yeah, a great point. I mean, we saw it in the questionnaire that Linda put together already. There's lawyers that are having, solo practitioners that have revenue of $500,000 or $1 million a year that decide to not purchase insurance because they think that they're infallible, or they think that they're going to get sued, or they just don't put it in their budget for that year, and like drivers do in California, drive without insurance, go bear. So all sorts of reasons. Should they be told that they've got to be insured for their clients who could certainly suffer a sizable loss? Otherwise, they could go after the lawyer individually if they're making that sort of money. But many times there's ways to make it appear as though they have no money, therefore dissuade a client from suing at all. So, Connie.
I'm not sure that we've really established how much power the state bar has over insurers of lawyers, but is it possible that part of the affordability analysis could be to examine whether, if we do at the end of this recommend mandatory insurance, that we also either recommend to the state bar, if they have this power even, which might also have to be examined, that insurers offer some sort of an affordability calculation that takes into account some of the things that we've discussed here. So for instance, when the low bono representatives were here, one of the things they discussed was an attorney who had been out of the market for several years and came back to the market, but had to pay a fee as if they had been practicing for the last 25 years, even though they hadn't been practicing for the last 7. I think they've been, I forget the exact example, but maybe had been retired for 7 and decided to come back to the law and had to pay this higher fee, but wanted to do low bono. But in reality, probably the statute of limitations on all those old cases had run, so the reasoning behind the higher fee was because, there's probably this backlog of cases that people could sue this person for. So, that kind of thing, or somebody like me, I just came out of government service and started a firm. If I got insurance today, theoretically, I'd have to get insurance as a 15-year attorney, even though nobody's going to sue me for my last 15 years of work as a government attorney. Do you understand what I'm saying? Like, could we add some sort of practical suggestions? Those are just 2, but maybe there's some more that we could add in, and just sort of put that into the into our suggestions under like affordability.
I think that is an affordability issue. Most of that gets worked out in an underwriting process where somebody, like Dan and Scott would look at a risk like that and get it to the carrier, and the carrier's underwriters would look at it and take into account if you've been working for the government for 15 years, there's no prior acts issue there at all. In terms of true affordability, if you have a means of getting information from a prospective lawyer insured that they practice in a low bono, pro bono, or access to justice type practice, could that somehow be taken into account in terms of, especially with mandatory legal malpractice, should that be taken into account? My view is I think that's possible. Remember that we're going to give our recommendations to the Board of Trustees, and then the Board of Trustees is going to send that to, there'll be a period of public comment, I think, in there someplace, and then it's going to go to the legislature. The legislature do what they want, essentially. So if they want to build that into it, whether we suggest it or not, it might not be a bad idea to address that within the idea of affordability and adequacy, affordability of coverage. It would be an interesting concept to introduce.
Those factors are generally taken into consideration, though. So you would not pay the same as an attorney who just has been practicing for 15 years.
I can answer the question about the state bar's authority. We don't have any authority to regulate insurance companies, so it's just limited to the world of the legal profession. So unless the legislature decided to grant us great powers, I don't see, we can't.
Yeah, the buck stops with the legislature on this. Once it goes from us to the Board of Trustees and then open for public comment, and then to the legislature, they'll decide what, if anything, how they're going to respond to this. But obviously, in the meantime, we're taking our job very seriously to make sure that the Board of Trustees and the legislature have what they need in terms of all these topics that we've been asked to address. Just a couple of things on timing. We're at about 11:50 right now. I wanted to go until a little bit after noon, so I don't want to close out the discussion now, and then we'll break for a little bit for lunch. One of the topics we didn't talk to Dan and Joanna about is the adequacy of insurance. I guess would be the limits issue. This is not a new issue. This has been around for a long, long time. And the issue is, okay, we have insurance either now or we'll have it through a mandated program, but it's $100,000. And we all know that lots of the carriers that write to the 1 to 5 market offer a major fraction of their policies are written on a 100 eroding limit policy with some provision for claims expenses in there, or 100, 300, and whether that's adequate or not. So I want to get to that. We may not get to it before we break lunch, but if we don't, we'll come back to it after lunch, and then we'll have our speaker at 1:30, and then I've got some more things to do after we hear from Professor Feldman. But I didn't want to close anybody out on this topic, obviously a really important one. Is it going to be affordable if we have mandated coverage? Is it affordable now? Sounds like just to sort of do a mini closing argument on this topic, it sounds like there's plenty of availability now, plenty of capacity in the marketplace for those that want to buy it, to make the decision to buy it, plenty of places to turn both in an admitted and non-admitted basis, and that the market is pretty good and pretty robust right now, and don't see, many headwinds in the near future, perhaps. But things could change, and one of the things that we all need to do as decision makers in this setting is to account for the potential that something may change in the future, or that it's just a good thing to do regardless, and it'll work its way out in the future. So sounds like most of the good news on the current availability. This is not 30 years ago where you had one carrier and if the state was in crisis, literally in crisis, because no lawyer could get insured. And we all went through that and sort of various iterations of that over the years, but right now pretty good. In terms of the affordability, huge issue, because it may not be affordable now, and when it's mandated, it'll become less affordable, or a more difficult choice for lawyers across the board to make, especially lawyers that have a rate challenge practice. So those seem to be the issues of the moment. Anything else before I close this out? On those two topics. Okay. Are you guys prepared to discuss the amount of insurance? Why don't we start that now, and then we'll break at about 12 or 12:05 or so, just to introduce this, and we can have this percolate through our brains in the meantime.
Sounds good. So Lisa and Joanna have contacted or have put together the limits that various agencies or forms of doing business have mandated as what they consider to be their minimum limits. And that goes back to just a law corp, which mandates $50,000 per claim, $100,000 in the aggregate per attorney. Then there's an LLP, which mandates the limit of 1 million, but that's in the aggregate. So the LLP, if you're two attorneys, you can have 500,000 per claim and then 1 million in the aggregate. As far as other states, Oregon's minimum limits are 300,000/300,000. Idaho is 100,000, 300,000. And Nevada is 250,000, 250,000. What I did, I contacted CNA on a number of occasions since our last, since the first meeting, to try to ascertain what claims in California were settled for over $100,000 to see if, in fact, $100,000 would be an adequate per claim limit. And the best I could get without breaching any proprietary information on their part was that about 40% of the claims they get from California end up settling, resolving for over $100,000. So when you talk about adequacy of limits, if there's that many that go over 100,000, one would think that maybe the 250,000 per claim would be the wiser recommendation. I did an analysis of the cost differences, and while significant, they're not astronomical. And I go back to the family lawyer, their $2,500 is for the 100-300 limit, $3,500 is for 250-500. So, I mean, anybody that argues that $1,000 is too much money to pay, period, obviously is going to have a problem paying for $250,000 limits. But when you recognize approximately 40% of the claims are resolving at a higher figure, and we're out to protect the consumer, one would think the 250. Now, I tried to balance that with, Glenn Olson here was kind enough to correspond with me on a couple of occasions just how a defense attorney in California, what they see with the small firms. And with talking with Glenn, he's never seen a claim go beyond the policy limits. So 100-300 would be adequate in the sense of at least protecting the attorney. Now, am I miscalculating that, or?
Yeah, with the exception that I just looked at small claims that we've handled.
Right.
And to see if, you're right, if in that 100, 300 range, we had any that were over limits problems, and you're absolutely right, you don't see it. But I have seen over limits claims with bigger limits.
Yeah, and, you
We'll get to
know,
that.
frankly, on this, I think this panel, you know, with the statistics to where they are, we're talking about the small firms.
Yeah.
Yeah, I mean.
Well, here's the phenomenon, and I think maybe reading between the lines, Heather, you can jump in on this, of what the legislature asked us to do, and that is a $100,000 limit, you know, sort of a cheap way out that leaves a bunch of victims out there with not enough compensation for, in those severe cases, you know, a grievous legal malpractice, and, you know, yet they only end up with this policy, and then on top of that, $100,000 policy, and then on top of that, it erodes
Right.
our defense cost after a certain level, so it's a pittance at the end of the day. So I think that's really, and it's not a new issue. And the issue is, you know, should those policies be sold? And do we leave an aggrieved client in the short end of the stick on that? Because what goes on is, once a plaintiff lawyer learns that there's only a $100,000 policy available to a lawyer, and that at some point it'll start to get even less when you eclipse the allowable claim expenses, and the $100,000 becomes 90 or 75 or 50, especially when we as defense lawyers call the other side and say, you know, this is an eroding of this policy, and I'm happy to spend it, but you may want to ask me for it now, et cetera, and all the other tricks we have up our sleeves to protect our clients, the lawyer, insured, defendant, and we usually get our way, you know, with something like that. We're highly successful. Is that a good thing? Is that a good thing? So that's the issue, and it's been put to us before on Copley, and it's been put to this committee now in a more pointed way by the legislature to say, is that what we want to, you know, support here? That sort of policy where, you know, the lawyer ends up getting a great deal. Maybe it's not $1,200, but maybe it's $3,000 or $4,000 for a $100,000 eroding limit policy. Sort of can put up in disclosure, I've got insurance, even though it's only $100,000. You know, pay on the cheap and then leave the client holding the bag. Is the blunt way of putting it. So, I don't know.
And I'm sorry, were we going to reserve this discussion till after?
Yeah,
Okay,
I'll
wait
want to
till
wait.
after lunch,
Okay.
yeah.
So that's in my, you know, sort of plebeian way of framing that issue. That's the issue. Anybody want to quickly add to that before we break for lunch? Because I think we're right about, we're right about it. That's the issue. So, so you understand the context of where this issue comes from. So what's the solution? Well, you know, you mandate insurance and maybe make the limits higher, or make them that they don't erode for expenses or whatever. But that's the way we need to look at it. All right, thanks for your hard work. Let's break for lunch.
What time do you want to start?
Let's try for somewhere around half an hour or so. I want to be able to have more discussion before Professor Falmouth comes at 1:30. I'd like to get him on right then, and then we've got some stuff to do after that. So let's try for 12:30. You're welcome to bring your lunches back here or wherever you want.
Okay, great.
That'd be good.
Well, you made it almost.
My new coffee. This is my first cup of coffee ever, I will announce that. In 47 years, I've never had a cup of coffee, and I was across the street and they sold this to me. And so if I start acting weird. I'm sorry.
We are true confessions.
I was just thinking, we did.
All right, folks, we are
Francisco last
back
time, wasn't it?
on our live feed.
Yeah, these aren't wonderful.
Welcome back to those
Ours is good.
that are following us by the live feed. We are now back. And so let's continue with our agenda. But I want, this is, I'm going to take this a little out of order, but I think it fits in the larger sense. Linda prepared a PowerPoint of the ABA legal malpractice claims statistics for 2012-2015. Just to set this up, many people in this room know that the ABA Standing Committee does an analysis of legal malpractice claims, I think every 2 or 3 years or so, right, Heather? For 3 years, maybe?
Sorry. They do it every 5 years for I believe.
Okay, all right, in any event, it's something that's regularly done
4 years.
by the ABA, and it's great because they break it down into all the nomenclature that we're used to in frequency and severity and the ranking of the types of mistakes, the ranking of the practices that most commonly generate legal malpractice mistakes, the size of claims and those sorts of things. This is just more great information to have, and we can certainly assume that these are the types of numbers and trends that those that have to make these hard decisions on the Board of Trustees and later the legislature will clearly know about in terms of the prevalence of legal malpractice claims. And it's here, it's been here for 30 or 40 years now, and there's no doubting that California has a cottage industry of legal malpractice claims, so good to always keep these things in mind. Yeah, Linda?
And the context in which I wanted to present this information does sort of fit in with this topic of the ranges of coverage that are recommended. And I distilled information from this profile specifically about claims and costs. So that's I didn't pull out information about the areas of law. It really was just on the coverage level. So for those who are not familiar with this ABA profile, this is the source of the data. So they have 13 U.S. NIMRICO company members, 10 Canadian NIMRICO members, and 9 commercial insurers that participated in this survey and provided information. And you can take a minute to look at this, but what you'll see is that 66% of the claims were made against firms that had fewer than 6 attorneys, the 1 and the 2 to 5. So that's a really high proportion of claims there against these small firms. And then this ranks the percentage of claims by the amount of the expenses paid. So these are the defense costs. And as you can see, 67% have no costs. But of the claims that were paid, 96% had expenses up to $200,000. So only 4% that did have expenses had expenses that were over $200,000.
Does that make sense to everybody? I mean, we look at these statistics all the time and have as part of Copley and other committees that I've been on over the years and working with insurance carriers. I mean, there's this huge percentage of cases out there, claims, I should say. Maybe they don't always mature into cases at the insurance company level that are just simply closed without any hiring a defense counsel or expenses incurred at all. Sort of good news, I guess, for the industry, but you'd think that once a claim is made, a lawyer's engaged, and there'd be at least some engagement on that case, and money would be spent. But actually, with huge numbers of claims, don't ever go anywhere. Is that an indication that there's many frivolous claims, or that
the, client decides not to pursue them, or maybe they find out that the limits aren't enough for them and they decide not to pursue it, and there's all sorts of reasons why claims don't get prosecuted past that stage.
And then here, this shows claims by indemnity dollars paid. And again, 62% of them didn't pay anything. And of the claims that were where there was a payment, 88% again only reached that $200,000 level, and 8% paid between $200,000 and $500,000. And this is just the last slide in terms of the total dollars paid. 43% didn't pay anything, and of the claims that were paid, 90% reached that $200,000 level, and an additional 7% be paid between $200,000 and $500,000. And this is again total. This is the expenses plus any indemnity payments. So that's the very limited amount of data that I pulled from that. Again, focusing on this question about ranges of coverage that are recommended, but it looks like most of the if there were limits of $200,000, that would cover 90% of claims.
Can I ask you a question?
But this is nationwide.
Does it include Canada? Because it had Canadian insurers in it as well.
Yeah.
And so we don't know how California necessarily compares.
Right, and that's where we're waiting to get hopefully information from Lawyers Mutual later this month. I think at the end of the month we should have some information from Lawyers Mutual that's California specific.
Pat, can we agree that the California numbers are slightly different than this?
Yes.
Other than that, you're going to have to wait.
Yeah, the suspense builds.
Yeah.
In some ways it might be better, and in some ways it might not be. I know just in passing, in speaking with the actuary, just a comment he made is that about 85% of our claims settle. And that means defense, indemnity, everything under $100,000. That's a big number. So I don't know how it all shakes out here in terms of, like, I know that we have many, many claims that are frivolous, that you still have to get rid of them. So maybe about, I think the average is about $48,000 to get rid of the non-meritorious claim. So that's well beneath any limit because we have a $50,000 expense allowance that sits outside the limits, so the limits are never touched. So we have a lot of moving parts in our data for you, but it will be slightly different than this. And Dan's company rates insurance and premium different than Lawyers Mutual rates premium, and that's a factor that's going to play into this. But generically speaking, the statistics should be fairly on point for California.
Yeah, Heather.
I quickly emailed the ADA to get accurate information. It is indeed, as reflected by the title, released every 4 years. And the next one won't be released until 2020, covering obviously, as is apparent, 2016 through 2019.
If I can add one thing, I mean, when you talk about Lawyers Mutual or Aspen or CNA, these type of insurance carriers have people dedicated to handling claims. Most of them are attorneys themselves in the claims office. And you're going to see a much higher percentage of claims resolved for no pay through those claims office. Now, the carriers themselves are paying qualified people there to get in touch with plaintiffs' counsel and explain to them in a professional way that, hey, you don't have a case. Whereas you're going to have some carriers that don't have a history in the market, they don't have a dedicated lawyers, professional liability claims department that will have to right away hire attorneys. So those carriers, the statistics might be considerably different. They'll have probably less with no pays. If that makes any sense.
Glenn? Yeah, I don't know if we can distill it from, I imagine we can probably from these slides, but I know when I worked for CNA, one thing we looked at is zero pay claims, and then we would look at claims in which we actually paid money. And those are two different universes, and you want to know, what's that universe look like where you've had actual expense dollars paid, because that informs this issue of what's an appropriate limit, particularly in the eroding universe.
So we may be able to do it actually from the information we have here if you just kind of segregate out the zero pays from the other claims.
It's a great point, because really the more useful information here would be you've got some form of a colorable claim that's being advanced by a lawyer with some expertise. It's probably will have assigned defense counsel on the larger portion of those, and is proceeding in a bona fide basis through the system. Would an example of a claim that gets closed with no defense dollars be where a lawyer insured puts the carrier on notice prophylactically of a claim or a potential claim, or a laundry list of claims at the closing of a policy, so those just simply never materialize?
Yeah, that's exactly right. And if you look at like larger firms, for instance, they'll often bordereau 15 claims, right, that never mature into anything or whatever, but are just followed. They're reported and followed, and they close out, in due course without anybody ever paying anything. So that's basically picking up often the incident reporting, where you report an incident, but it really never matures into a full-blown, expense-laden claim.
Right, and can we sort of assume that because these are claims-made policies and lawyer insureds, if anything, are trained to put carriers on notice of just about any nastiness from a client, that maybe there'd be a larger percentage of claims that end up not materializing just because of the nature of the beast?
Yeah, that should be right. I mean, if people want to protect their right to coverage, they should be making a claim within the policy period. So
right. So there's sort of a built-in motivation for the lawyer to put the carrier on notice of a claim, even though it doesn't ever translate into a real claim with real expenses and real prosecution. So I think the point of all that is the better tranche of data that would inform us on the expenses and indemnity associated with a claim, and the amount of coverage that a lawyer would need to indemnify to be covered under a policy would be those claims where there actually is some maturity to the prosecution of the claim.
Yeah, so I think that's right. And you could look at that, you can segment that into no paid indemnity but paid expense, or a combination of paid indemnity and expense. There are a lot of ways to slice and dice it, but you remove the zero pays out of the equation.
Okay, and that's how that CNA still does it, if you know, Dan.
I'm not certain, but when I got the figure of 40% of the claims paid out over 100, or cost CNA over 100,000, that was claims, not incidences. So they did pay out.
So you'd already filtered it.
Kind of, the laundry list kind of situations. Never got to that level. And, in all honesty, at that level, those were not where there was any harm to the public. There was just an imagined potential situation. So nobody pursued a claim.
Right, okay. But if we're talking about on claims that actually matured into incurring expense, the average was $100,000 in claims expense?
The way they worded it to me was 40% of the claims that do amount to expenses are above 100,000.
I see, okay.
Now, that figure would be different if we only wrote a $100,000 limit, I think. If we wrote, I shouldn't say only, but if we offered a limit of 100,000, could very well be that the number 40% would be lower.
True. True. I just want to add that. So I think we're talking about when Glenn talks about incidents, we're talking about potential claims. Some policies require you to report them. Some policies don't even require you to report them. And there is the laundry list idea you talk about, although, those probably wouldn't be factored into, I don't know, when they say 2015 claims paid, I don't know if they mean claims or they just mean incidents. And that could be, that's a sort of a different scenario. So somebody could have a claim made against them, cost nothing, because it doesn't go anywhere. It was, somebody just was upset and they said, I want my money back, or I want, you messed up and I want X dollars, and then it doesn't go anywhere. Or you could have just somebody who says, there might be something happening here, I'm going to put you on notice as a potential claim, and then it might not go anywhere. So those are two different scenarios.
Agreed.
The other thing, I guess, is that what this doesn't take into account is deductibles. And so you could have somebody with a $5,000 deductible, you could have somebody with $1 million deductible. So I don't know, I mean, I'm not, not to come off the works or anything, but just say, like, as far as how, how this translates into what we're talking about, it could just be just other factors that we probably need to consider.
Yeah, and I don't know from this data whether it included those situations where an insured paid expenses as part of a deductible obligation or not. I might get the sense that what was reported here was that it was the insurer expenses, which would only incept after the deductible, depending on what kind of deductible it is, it would only incept after the deductible was satisfied. Yeah, okay. Yeah, Joanne.
My concern with this data is it's only looking at the universe of insured attorneys, and what we're mostly concerned about is those attorneys who don't carry insurance. And there's just no way for us to get the data about what those claims would look like. What would be the appropriate limit for those attorneys? And there's no way to know how different that subset would be. Would they be fairly close to the same type of numbers, or would they be very different because these are people that don't normally carry insurance? I think why this is an interesting data point to be looking at. I don't think it's the right one for us to be focusing on.
Good point, because I think what you're saying is don't necessarily jump to the conclusion that we have all these claims where there's no defense dollars and no indemnity dollars incurred means that they all have some low value. You'd have to slice the data in a different way to determine, what the indemnity exposure is or was in the case to figure out the appropriate insurance level.
Well, this only looks at insured attorneys, so that's the only group we have the information from because they have insurance companies keeping the data. We don't have that data for uninsured attorneys.
Right. I mean, and I don't know if it's fair to assume it would be about the same or not. Yeah, we don't know. There'd be lots of reasons why it might be the same. There'd be probably more reasons why it would be totally different.
I just wanted to share my thought that I had before the lunch break with the group. For years, I thought that the 100, 300, even if you had a defense allowance on top of that, was grossly inadequate. That was my opinion for maybe even decades. But my thinking has changed largely through this process, and here's why. At least, and again, this is in my experience, but like many people in this room, I do have substantial experience in this area. $100,000, especially if you have a $50,000 defense allowance on top of it. In other words, the 100 doesn't begin to erode until you spend 50 in defense costs. And as Kathy pointed out, most claims can be resolved within $50,000 in defense costs. Is by and large more than adequate to handle the vast majority of claims. So it's hard for me to even imagine a scenario. It would be a very rare scenario where that limit wouldn't be adequate to cover the damage, assuming that somebody has been even damaged. A lot of the cases, again, are frivolous. The people who are really, if you want to say, quote unquote, harmed by the 100, 300 limit aren't the consumer. It's the insurance company and the lawyer, in my opinion. And here's how or why. The lawyer, it's very frequent that the lawyer will say, I want to fight this. I want to go to trial. I want to do all these things, but you don't have enough money with $100,000 to launch a full-blown defense and go to trial and do all these expensive litigation means. It's very common that I run across somebody who has a 100, 300 policy, and they wish they had more insurance just so that they could launch the type of defense that they want. And with regard to the insurance company, it's I think a well-known fact that with 100, 300, sometimes insurance companies overpay, simply by virtue of the fact that the plaintiff's attorney will, learn the limit. They'll make a demand, and the demand is within the limit and less than it will cost to take the case to trial. And often the limit wouldn't be adequate to fund the entirety of a trial. So it forces a settlement scenario, and sometimes it forces a settlement scenario in excess of the true value of the case. I've seen that dynamic many times. But in terms of public protection, whether the 100, 300 limit protects the consumer who's been harmed by legal malpractice, truly harmed, my opinion, having thought long and hard about this over the last 6 months since we began our process, is that it's probably adequate. And I'm very familiar with this study. I participated in this study in the past. As Randy knows, I used to be a member of the standing committee And while Joanna's right, this data isn't perfect, this is about the best data that's out there, Joanna. Everything I teach on legal malpractice, I cite this particular study because it's about as good as it gets.
I would agree wholeheartedly with Heather on that now. After looking at this for the last 6 months and thinking about it, 100, 300 is probably adequate for the person that we're looking to protect here. I mean, we're not looking to protect the big client, Mobile Oil, because that's really not part of this. Those firms have insurance, but for the small client that you might make a mistake on here or there, with a 50 to 1,000 or even 500 or 100,000 of defense costs outside the limits, it's, I think, adequate.
Yeah, this is not the first iteration of this issue, and I'm presuming that the genesis of the legislature's questions to us in business and professional code section on this issue was the sense that maybe a $100,000 policy was leaving a client victim less than fully satisfied with their damages, with recovery of damages as a result of legal malpractice. And the fact that the insurance industry was sort of complicitous in selling these $100,000 policy for a lot less than what it would cost for a $500 or $1 million policy to insured lawyers that wanted to be insured so they could tell their clients and disclose that they have insurance. So that was, I think, sort of the perception, and I think that's probably why we have this question. It's a great question, though, because I think it still exists in the larger sense, and it deserves great thought on what it should be. CNA has obviously made the decision they're not going to sell policies less than $250. There's smart people there who would have come up with that. LMIC, Arch, and many others sell policies that are $100,000 eroding limit policies, and they've looked at those long and hard. I think ultimately it's really driven by the sensibilities of the insured, who are, really there's probably 2 or 3 factors that most lawyer insureds decision makers, and those 1, 2, and 3 reasons are cost, and cost for the most part. And so when they get a list of what carriers are available in this marketplace to provide me coverage, it's I now need to get it, or at least need to disclose that I have it. And even through competitive rates, they're going to probably choose the lower of the 3. And so it's a product that is in demand. So the issue is that something that we should allow to perpetuate, or that the state should allow to perpetuate? And are there victims of that phenomenon? And based on this data and similar claims data that's unique to California, it doesn't appear as though, based on claims expenses and indemnity payments, that there are many claims that somehow fall outside these limits and leave a client without a full and effective remedy.
Given what we've learned so far in this group, the fact that a law corporation only needs to get 50, 100,000 policy per attorney, first of all, you can't find it, and second of all, it doesn't sound like it's adequate. One recommendation we might want to make, which isn't a mandatory issue, but to change the limit requirement for law corporations.
Yeah, that has been around as long as I can remember. Does anybody know that one in defense is sort of like, the micro, that hasn't changed in 35 years, despite everything out there. Heather, you look at me like you know the answer.
No, I think it's been a long time.
It's been a long time. Yeah. So that might be something to consider, because there's sort of a presumption there. Well, if we're going to make corporations with one lawyer buy 50 grand with the coverage, then why seem inconsistent if we mandated coverage at a much higher level?
Well, even if we don't mandate it, I think we should recommend these.
I think that the Attorney Regulation Department is actually expecting that kind of a recommendation. They were going to be looking into that question separately, but since this working group was formed, they decided to wait to see if a recommendation.
Very good.
If I can just add one quick thing, Randy, on the idea of CNA electing to offer limits of only 250, 500 and higher, that was not done taking into consideration the consumer. That was strictly done from a corporate level of, being able to remain in business in California and write profitable business. Their concern was that they would be cutting too many $100,000 checks for totally frivolous claims because of bad faith and things like that. But they are willing to do the 100, 300 if we would mandate that kind of coverage.
Okay, well I mean, we've identified now both sides of the $100,000 limit or $100,000 eroding limit policy. One is it results in a higher amount of a payout because any insured lawyer or any insured's lawyer defense counsel is going to say they've demanded the $100,000 or whatever remains on it, you better take this now. It is sort of a hold up, true, but you don't want to be bereft of coverage once I spend the $150,000 in defense costs on this claim, and sitting with me at trial with no coverage is probably not really smart. So they pay and maybe overpay. Or the other side of it is that the client victim is left with a lower level of payout because of the policy, because the defense counsel like me and Glenn and Heather going to the plaintiff's lawyer saying, I got a $100,000 eroding limit policy, you better take this before I spend it. And and they face the conundrum of saying, okay, well, they've got to go to their clients and say, here's what we can get now, this is the low-hanging fruit, so let's just take it and go away. So I don't know. Yeah, I mean, I've been on both sides of that issue, so I don't know where it comes out statistically. I would say, and it all actually goes back into the lawyer, consumer, insured making those decisions, because the irony is, somebody like you goes to them and says, you buy a $100,000 policy, you buy a $1 million policy. Well, $1 million policy sounds great, but that's going to cost me a lot more money. What's the 100 going to get me? I'm thinking if I get sued, I can offer the 100 to my client and probably get out of it and save a bunch of money in the meantime. So I'll take the 100. Right?
Yeah.
That's the decision making part. So the question is that a scenario that creates victims? Folks that are getting less than what they should. That I think is the issue to be addressed. So on what percentage? Can you give us a percentage of policies, of all your policies that are sold are that are 100?
I don't know that. I'm going to get that for you. That's going to be part of our breakdown for you.
Yeah, I know from the ARCH program, without getting into any proprietary information, that it's a significant number. And we shared that with the state bar, and anybody who came to us over the last 10 years and said, tell us what you're doing here, we could say, well, here you go. And Glenn, I don't know if you can remember, but 40 to 50%, so it's a big number.
Yeah, I think it's at least, I want to say it's at least 50%. Okay. Kind of surprised me. It might be that or a little bit more.
So that sort of adds to the intrigue or the suspicion, and boy, you're certainly selling a lot of these policies out there, and everybody's sort of buying the Kmart model, and we want everybody to buy the Nordstrom model, and there's a lot of them that are sold, and they're profitable. They're profitable.
I guess
the business.
One question that I have, and I know the answer to this, I think, because it's a different structure completely, but when somebody writes it under a captive like Oregon, they're picking the $300,000 limit. So I think we need to be able to articulate if we feel comfortable with 100. And I agree with Heather, actually. I think I've kind of come full circle too. I used to think that is a crazy low limit. Who in the world would want to do that? But experience teaches that it works for most people, and probably definitely works for the public. But when people mandate it in other states or require a particular level, they always pick 250, they pick 300. So it's just a discussion point for us that we may, want to be able to say, this is why in the free market 100 works.
Although in Idaho it's 100, 300.
Yeah.
So that,
but I think isn't 250 in Nevada though?
Yes.
250.
Yeah, and 300 or.
I just looked it up for Law Pro, which again is the mandatory malpractice fund in the Ontario region of Canada. And they actually mandate 1 million, 2 million. I'm looking at their website, so perhaps this is wrong, but that's what it says. And the base premiums, this is a couple of years ago, but were $33.50 per insured for $3,350. So that's interesting that Canada appears to require a higher limit. It'll be interesting when they come and talk to us on November 13th. Perhaps we can inquire about that further.
Those are Canadian dollars.
That's a good point.
It's almost like a peso.
What is
That's a lot of
800,000.
Yeah. I mean, the problem is trying to translate this into California dollars is the California reality and the California litigation reality here. So these numbers get skewed pretty quickly with the expense and the indemnity and so on. We could never deliver, a free market policy here, $1 million of coverage for $3 grand. So affordability issue pretty quickly. So, is there anything else that we need to discuss as part of the adequacy, affordability, and missing
Availability,
affordability, availability, adequacy, 3 A's that we've missed on this? Anything that any questions, thoughts, issues to leave us with in terms of committee members working group members processing this and what we need to look at in terms of the various models?
I would be very interested to hear what Canada has to say on November 13th, but I've come kind of full circle, as Heather and Glenn have, that having the 100,000, 300,000 will protect the public significantly better than the idea of expecting attorneys to pay for 250 or 500,000. So, unfortunately, the statistics, getting them out of CNA has been really tough. I'm anxious to hear what Kathy has to say from LMIC. But don't have anything else to add here now.
Okay. All right. And I'm sorry. Yeah, Kat.
Randy, in talking to our claims department on the limits of 100 versus 250, what their observation is when there's more than 100, then the plaintiff's lawyer wants more discovery, more this, more that, so that the expenses go up, not necessarily what you will settle it for, but the defense goes up in terms of what it costs to get rid of it, when you could have settled it with the lower limit at the same amount, just not more expenses. And so you have to weigh, and someone said it earlier, when you have higher limits, you have higher challenges to get to the $1 million settlement, whereas when you're at the lower limit, it is what it is, and for the most part, it's going to cover the loss. And I'm not sure why we think that someone who doesn't have insurance wouldn't have the same kind of losses. I don't know that they would or wouldn't. It's a good point that Joanna brings up. But if we expect that the ABA stats are kind of the universe of the United States, then that should apply to California in the sense that uninsured lawyers and insured lawyers would have generically kind of the same claims, maybe, maybe not. But I can tell you, based on everyone else's questions, why California has more claims is one, we have more lawyers, defense costs are more, statute of limitations is different, motion for summary judgment, I think was part of it. We have a lot more factors that bring the defense costs up, which ultimately may get rid of the claim for under the 50, or may not. But that's the same reason that someone will settle, because they know that all those other things factor in. If I only have 100, I'm going to take the 100 versus risk all this other stuff. So there's a lot of things that come into play, and I think the 100, for the most part, we can't insure all losses 100% uninsured or insured lawyers. So if it takes care of the majority of the problem and protects the public, it seems to me that that's kind of where we have to land.
I would agree, and I would think that the uninsured attorneys would be more likely to fall in the smaller claim area than the larger. I mean, for one, their client base, somebody that's got a potential deal for a couple of $1 million, whatever it be, property or something, is likely going to use somebody that's got insurance. So the uninsured lawyer is usually working on the smaller, that would fall under the $100,000 parameter.
Yeah, it's probably a fair assumption. Joanne?
And again, we are missing important data about what harm there is to the public with regard to uninsured attorneys. There's no data for that, there's no way to get that data. And so everything, we're just extrapolating from insured attorneys, we're guessing at the harm, and I think that makes it a real challenge, because we don't know exactly what the problem is we're trying to solve, because we don't know the extent of it, how big it is, how small it is. So it makes the entire recommendation process very challenging.
Yeah, well, of course, there's sort of two issues in there. One is what harm are the uninsured lawyers causing? And then your question is what harm are the underinsured lawyers causing, with a $100,000 product that they got for a fraction of the price of something that would provide a greater indemnity and coverage for an approved former client. So I think that's the way to look at it. Judge?
Is there any data that examines the dollars paid by area of practice or type of claim?
Severity would be that area. Frequency is how often there are claims, but the expenses or cost would be the severity side. And the data, I believe, would reflect real estate is of higher severity because of values in California. IP, although there's seldom claims in that area, when there are, they're very expensive to defend, and if there's a mistake, very expensive to indemnify. I don't, what I tried to get from CNA, I was extremely disappointed in that the actuaries just pled they were so busy they couldn't get to my request, so I really was unable to accomplish what I thought would be easy.
Yeah, it seemed like a lot of the errors referred to in one of the surveys were kind of procedural in a way, failure to file in time, et cetera, as it kind of cuts across. But I was just wondering if, like, family law or something was the majority of claims, let's say $60,000 and under, and then it started getting more into estate planning or something else, because at some point, I think there's a big difference in the the sophistication of the user and how well the disclosure requirements work. If somebody has a $500,000 transaction and they don't bother to check out their lawyer, it may not be quite the public harm that there's somebody's going to a lawyer the first time to get a small will or a family law case, and it may not have the same urgency to have some kind of remedy to it instead of just relying on the disclosure requirements.
Yeah, I've never seen statistics broken down that way. We always get, the top 5 or 10 areas of exposure, type of practices exposure, and then we always get the top 5 or 10 of the mistakes that are made. We could probably guess or make certain assumptions about which of the practice areas that generate legal malpractice claims result in the highest claim expense or indemnity payout. If family law is a large generator of legal malpractice claims, we could all think of family law legal malpractice claims that don't generate that big of an expense or that big of an indemnity payout. Wills of estates, you could probably assume both sides of that, where you have a failure to have drafted a will in some ways that would have paid X amount of dollars that never could be used. IP, I would agree, that's probably at the high end of the list. They're infrequent, but they're severe. Being paid out of those claims would be probably quite dramatic. So, I've never seen anything broken down like that. I do agree with your thought, though, that if a consumer client doesn't do or care about the due diligence about a lawyer having malpractice coverage, you might assume that the amount that they have at risk would be smaller. That's a fair assumption.
And maybe if it's smaller, the reason the consumer is going to that attorney is to maybe save on legal expenses because they're just frugal or something. And again, he gets what he deserves. If he only has recourse to get 100,000 versus $500,000.
I think, I would just add that as far as well, you mentioned real estate. One thing to keep in mind, California, you look at a lot of these surveys are nationwide. A lot of states have attorneys handling closings. California, I think a lot of closings, unless they're really, really large, I assume there are no attorneys involved. So it's kind of like a section to pull out from most of this stuff when you look at the frequency, and that's a pretty frequent area in many of these surveys. And then as far as severity, I think what you said is true on the numbers. I think those areas like IP, those are pretty, and now I think with trust in estates, especially with the, I've talked about this before, represented on this idea that, we're going through what's going to be a huge transfer of wealth. So you're going to have these very large estates that are being transferred, so you're going to have cases involving very high severity there as well, I think, in addition to the fact that we have the frequency going up and the business transactions. Right. So.
Okay, so thanks for leading that discussion. Obviously, an area that is in need of, perhaps some more reliable statistics. But I think we did a good job of sort of getting to the bottom of the essence of what it is we're to examine there. And we've got some challenges and coming up with some ultimate recommendations and analysis on those issues. Unless there's anything else on that committee's work, Professor Felmuth is here, sitting patiently in the back, and Professor Felmuth, we have reserved a spot for you. If you're ready, we can have you address the working group now. And if you could step up to the table in front of one of these microphones, that might be best. And while you're getting up there, we did provide a copy of Professor Felmuth's testimony. It was in the materials. I've read it. It's great. It's provocative, maybe. And it's certainly based on many, many, many years of in-depth experience in this field, which we've all been part of in some way, shape, or form. So, Professor Felmuth, if you're ready, you can start with your introduction and tell us a little bit about yourself and your background and what brings you before the working group today.
Well, thank you. I don't want to repeat too much of my testimony. I don't want to read 13 pages or anything like that. I do have a few things to say. First of all, with regard to being provocative, as I tell my staff almost every day, I don't care I have tenure. So that's one advantage in listening to me. You have my real views. I'm not getting paid here, and neither any of you, and I'm very aware of that, by the way. I am very aware also that this is a very impressive group. I know some of you by reputation, others of you personally. Joanne, of course, and Heather and others, and of course Kathy Hamilton, who's I think overseas right now. But I think your task is really important. I became interested in this issue, of course, 30 years ago. When serving as a State Bar Discipline Monitor, I noticed that this was a problem. I thought it was a problem then, and I'm very happy to see a group like this with the intelligence and background and experience is tackling it. I was hoping that would happen in 1989 when I first said it should happen. I told everybody I thought it should happen. It's been a little while waiting, but you're here, you're doing it. I'm very happy you're doing it. The first part of my testimony, I don't go too much into my background except the Senate Public Interest Law, monitor state agencies, not just the bar but others as well. We're familiar with them. 40 years we've been sending students to the meetings, doing the California Employee Reporter. My publications are in this field, so for white collar crime and other publications. I'm a former antitrust prosecutor. I've been involved with the bar, not only as a Barcelona monitor, but in terms of various legislation. We sponsored the bill to subject you all to the Open Meetings and Public Records Act. We sponsored the bill to separate the sections out from you. We sponsored the bill to explicitly declare that public protection is your top priority, mandatory. It's now on all your bar cards. Thanks to Joe Dunn. Thank you, Joe, for that. And I've been very much involved in testimony and sending students and educating students in this area for 38 years. So I do have kind of a feel for what you're doing and what you might do, and I'm very heartened at listening to your discussion, because I see it as substantive, it is seeking out facts, seeking out impacts and choices and alternatives, and that's what I wanted to hear, and I'm hearing it. I want to give you maybe some ammunition, because I think you're going to have a recommendation that will be positive. And here's some ammunition for you. Number one, you've got, all of you, all members of the bar, have a duty to protect the public, number one. It's in the statute. Number two, the basic regulatory function that we have for all the agencies we look at is to prevent dishonesty and incompetence. So you provide, and if you don't prevent it, provide redress if you have it. And there's a nice interaction there, because to some extent maybe you should be providing the redress, all of us, if in fact we fail to provide that level of competence, because we do control that. I don't think we control it very well. I don't even think it's bona fide. I think we have a tendency, once we're in the castle, to raise the drawbridge. Every regulatory agency we look at in California has to have its bar exam correspond to its actual production of competence, relevant competence at the time. They have to do it every 5 to 7 years. The bar hasn't done it for 30. It's doing it right now, finally. But it hasn't been an area of focus at all. I do think the bar exam has relevance to competence. Of course it does. But everybody at this table knows you don't practice law. We're not Abraham Lincoln anymore. We practice in one of those 24 areas, and I listed in my testimony the 24 areas that I've kind of figured out, I think. And very few attorneys practice in more than one or two. Very few. And you have to be competent in immigration law, or bankruptcy law, or admiralty law, or whatever area you're in. And they're all very different. We know that. And we don't have any requirement at all to demonstrate competence in any area of actual practice relied upon by consumers for the entire career of the lawyer, period. Nothing. Zero. We don't even require continuing education in the area you're practicing. We don't have the Climate Security Fund cover malpractice or errors or damage from that source. The discipline system, which I studied carefully for 5 years, does not really go after this issue. First of all, the bar discipline system, if you didn't know it, is funded at maybe just over half what it should be funded. I haven't looked at the legislature to correct that, but I hope we'll be able to do that soon, because when I was state discipline monitor, it was $410 yearly dues, and they went mostly to discipline. It's the same amount now. 30 years later, it's the same amount. Someone mentioned micro. Hey, any number you come up with, you come up with a 100,000, 300,000 number here, fine. Put it under the CPI, please. Put every number under the CPI. Do not freeze things. Okay. I think we have, in addition to this, now we have the situation of not really assuring competence in any kind of bona fide way. We then have the issue of redress. And we have a substantial percentage of attorneys running naked, and everyone around this table knows that means that they're essentially immune, they're not going to get sued. I've been an expert witness in malpractice cases, and I know malpractice attorneys, a number of them pretty well, and they're not going to take, I'm talking on the plaintiff's side, and they're not going to take a case where there's not a deep pocket at the other end that they're not going to pay. They're not stupid. And so therefore these people who are running naked are essentially immune from any remedy for their clients, which is not acceptable, should not be acceptable, should never have been acceptable. We were battling in the 80s about, well, at least disclose it. That doesn't mean much. I mean, I had to fight to get it disclosed. And I think that's kind of weirdly insufficient. So we have a duty to provide redress. We could simply require it of everyone. It's one way to go about it. But we have a concern over what I call low revenue attorneys. And I share that concern. I'm very aware, very concerned about what we've done in terms of my end of the process, which is creating attorneys in the law schools. Tuition of $50,000 a year, it's ridiculous. It's nutty. I could go into some detail about the kind of price-fixing antitrust dynamic that leads to these high tuition levels. It's, oh my God, Loyola has got up 10%. We're a better school. We've got to go up 12. And that's what's going on in faculty meetings. I'm in the faculty meetings. I see it. And so we've gone from $3,000 or $4,000 a year to $40,000, $50,000 a year, and the rest of the world gets lawyers out after 5 years of higher education, and we take 7. So we're getting these lawyers out with $400,000 or $500,000 in expenses, living expenses and tuition. And we're concerned about those who are on the low revenue side. And I agree, although I think we should take some trouble working on the underlying problem that's creating their high pressure. And I just want to mention a few things that I didn't include in my testimony that I want you to think about, be aware of. Did you know that if you're a doctor and you go in an underserved area, and you spend 3 years there, you receive not 5, not 10, not 50, but $105,000 in loan forgiveness. And you know that a large percentage of those doctors stay in those areas? That's what the medical profession does with regard to the problem you mentioned, a good problem, I think, a correct problem you mentioned. Well, Hertzberg, some, I don't know, 12, 14 years ago, got a statute in that allows the bar to do the same thing. You've never funded it. I don't mean people on this table have never funded it. I mean the legislature has never funded it. It's never been funded. Never been supported. So if you want to talk about sympathy for those people, and I have it, we even have at USD, my school, a public interest loan repayment program where we gather money in charitable contributions and give money to attorneys who go in public interest law or immigration or legal aid, areas like that with low income. We do what we can, but it's de minimis compared to what's needed. And compared to what doctors do and what the medical profession does in this area. So on the one hand, you have sympathy. On the other hand, you all got to be aware, and I think you are, because I'm sensing a lot of sophistication in this room. People don't understand the subtleties. Those attorneys you're worried about, who are practicing immigration law, by the way, public interest law, those are my students, by the way, 1,000 students from our program, so I know who you're talking about. Their clients are going to get hurt the most by lack of redress. Because if you're I have an article called Theory of Regulation. I talk about why we regulate and the different aspects of regulation and where we need it, when we need it, and how we need it, and so forth. And in terms of the 24 categories of lawyers, some I'm not very concerned. I say in my testimony that some can be indemnified. I don't care whether a deputy DA, and I was one for 9 years doing antitrust work. I don't care if they are required to have insurance, not because they're indemnified. They have protection also other ways, fine. Or you have people who are in an environment where they're being supervised carefully. But this group you're most concerned about in terms of the cost to them is a group where the consumers do not have good redress, where $50,000 back will mean a hell of a lot. Maybe their flight back from Kenya after they've been deported because the immigration attorney screwed up, or whatever. You have those clients need this the most, and I think you're right in talking about maybe they don't need a huge amount. I think you're right about that. I don't think I'm not a consumer advocate, not who says everyone should have to carry $1 million and the lawyer should be sued for $500,000, blah blah blah. First of all, these are the kinds of clients that don't lose that much money. The ones I'm most worried about, and the ones you're most worried about in terms of the attorneys having to pay. So what do we do to make it easier for those attorneys to pay, and at the same time allow their clients, who are the ones we most care about, I do, are covered. They have an opportunity for redress. I think part of it is looking at the limits, and I think you're doing a good job with that. I like the fact you're looking at the facts carefully. But I think we need to look at all sorts of options. And I suggested one, because I want to feed into this very knowledgeable group and have you at least discuss it. And that's using the Client Security Fund as a high-risk pool, as a risk pool for those people who are in that category. First of all, you have to create some kind of rule for it to be eligible for the category. Maybe it's under 50,000, maybe it's under 60,000, maybe it's under 65,000 revenue, maybe it's also practiced in certain areas of law, whatever, however you want to do it. I think it will probably be ending up being between 10 and 20% of the profession. That's my guess. I could be a bit lower, a bit high, but I think it's in that range. And then you say, okay, under Linda's very interesting survey, you have maybe half of them saying, I can't afford it. Well, you can't afford what? You know, after spending $500,000 or getting loans, you should be able to afford $1,000 a year, I think, anyhow, regardless of how much you're getting in. But if you're that concerned about this group, and I don't disagree with it, have them put $200 in, and then have the Client Security Fund cover the other $400 or $500 that they have to, that you need to get the 100, 300 coverage. By the way, just for the fun of it, because of this role you have me playing here and talking to you about this, I applied for insurance. I'm getting cold now about, you asked for insurance, come on, you haven't bought it yet. How come? Well, 100, 300 for me, practicing in areas that are pretty high risk. I'm talking about juvenile law and antitrust law and so forth. They're kind of, poverty law and so forth. It's $923, my premium. And I think that's probably, well, maybe it's low. I don't know. But anyhow, I think at 100, 300, if you have this system, it could be very low because you don't have to pay, if you're talking about Client Security Fund Risk Pool, you don't have to pay the salesman. You're not paying salesmen. You're not paying the corporate headquarters. You're not paying a lot of the costs that are involved here. And when you look at what the premium should be in a situation like that, look at claims. You've got to be careful about looking at insurance, because we've been looking at regulated insurance now for 30 years. And if you want to know something, I'll give you an example, title insurance. What do you think the premiums are vis-a-vis the claims paid? Claims paid about 6% in premiums paid in title insurance. It's anti-competitive, it doesn't cover anything, those of us who practice area law know it doesn't cover anything, blah, blah, blah. So I'm just suggesting that if in fact your premiums are based on claims paid, I think $123 would be very high, not low. I think it would be more like $400 or $500 or $300 or $400. That's my guess. Now you're going to look at the facts more closely than I have, so fine. But make sure we look at the facts. If you're looking at risk pool rather than a private insurance company with stockholders and profit requirements and an executive to be paid and a salesman and all the rest of it, it could be a very different kind of level. You should be looking more at claims and the cost of claims rather than the total insurance premiums that are charged. So in any event, I'm saying that if you did that and you then made everybody contribute just a little bit more into the Client Security Fund, everyone I have to anyhow because it's underfunded. So we go from 30 to 70, or 40 to 70, you get another $30. That will pay the difference. And the advantage of that is, it's because it's $30 from 6 or 7 attorneys for everyone that's covered. So you're going to have $200 or $300 coming in for every attorney who's eligible for this in that system, plus the $200 that attorney puts in. So you're up to $400 or $500 already right there, okay? Maybe it'll be $40 or $50 per attorney. I don't care. Because frankly, the $410 should be $750 now, just with inflation. So it's way too low, and the Client Security Fund is way too low. I have to tell you frankly that I'm having trouble getting the legislature to agree to my idea of more money for the bar, because the bar is very unpopular in the legislature right now. Very unpopular, as you can tell you. But we're working on it, and for something like this, I think we can get it through. We can get it through. So that's really what I have to say. So I thank you for your attention, and I'm here to answer any questions you have or whatever about my thoughts.
We might have some questions for you.
Okay.
And by suggesting that your comments were provocative, it wasn't an indication that they weren't serious, but obviously they very much are. We appreciate the thought you brought to each of those. I read with interest your entire testimony. I have some questions, but Joanna, you had your hand up first. What thoughts do you have for Professor Fellman?
You very rightfully talk about the current status of the Client Security Fund, and Heather's also an expert on that. And right now it takes about 3 years for something to go through the process. And I don't know how we're ever going to get that fixed. Just dealing with what it covers now, I can see the logic to what you're talking about. My biggest concern, and maybe you can address what you think about this, is that the way the Client Security Fund operates now, the commission that determines whether or not there's going to be a payout waits until there's been discipline. So a decision is made, an adjudicatory decision is made by OCTC and State Bar Court. And so the commission waits until that comes in and then determines what the proper amount is based on that. What you're talking about is a system where the commission would be adjudicating whether or not there's been malpractice. And I'm not sure those individuals are qualified to do that. We have to change how it's operated.
No, I think you're going to have to change the system, absolutely.
And how would we do that?
Well, I think, I'm relying on you. I mean, there are a number of options here. You can theoretically wait until there's a malpractice judgment or whatever, and just say this is an insurer at the end of the road or whatever, or you could have some kind of staff to look, from the Office of Trial Counsel. The Office of Trial Counsel has an advantage because they do look at and measure competence to some extent. I mean, they don't discipline it like they should, but at least they they're familiar with the issue. And I think you want to be able to go to an attorney or an expert in the area that you're concerned about. And I think ideally you'd have some kind of group of OTC assigned staff who are able to consult with the lead attorneys in the substantive area where the claim might concern, and have them look at. This is what the medical board does, by the way. One of the advantages in hearing from me is the fact that I know what all the other boards are doing in all these areas. And the medical board does that. They assign experts. The medical board has no experts. They assign experts to look at a claim or look at a complaint, and rely on that. You've got to be careful because the expert you're looking at can't have a conflict of interest. You got to be a little careful about that. But theoretically, it's a way to go. And you can set up a system that will do that. You think, well, gee, won't that be expensive? Well, how much do the insurance companies spend? You've been talking about that all this afternoon. They spend a lot of money. We should be able to do it cheaper.
Yeah, but it would have to be funded by attorneys.
Yes.
At an exorbitant rate because we are underfunded now with just our discipline. So it raises challenges. If we had a lot of money, we could do a lot of stuff. I totally am behind you on that one.
Yeah.
Thank you for coming, Bob. I was interested in your comments about how you were one of the motivators for the disclosure rule in the first place. And obviously we have a disclosure rule, and we're going to have a whole day devoted to a discussion about the disclosure rule. A lot of people think that it's inadequate, the current one that we have, because it doesn't mesh with the concept of a claims-made policy. Those two, the rule disconnects from that. That was even recognized at the Rules Revision Commission as at least an issue when we were considering the rule. But my question for you is kind of a broad one. If the disclosure rule were to be enhanced and in such a way that it made meaningful disclosures, and that could be combined with certain public postings about malpractice insurance on the State Bar website, things that would allow a consumer to know whether or not you carry malpractice insurance. Would that, in your mind, Bob, your personal opinion, be sufficient to protect the public in this context of legal malpractice?
No, absolutely not.
And why?
Well, attorneys are in the business of drafting contracts and getting people to sign them and so forth. And we have a world now of terms and conditions where people click on things and don't even read them or see them. The whole world is operating that way now. I don't think very many consumers read anything, any legal document at all, ever. And you have an attorney who you're relying on, who you want to be your buddy, who you want to be your savior, who you want. And basically have that person make a disclosure and have you with $30,000 a year in income and no knowledge about the subject at all, and trying not to get deported to Biafra, and blah, blah, blah. And to think that that's sufficient when someone screws up and ruins your life and maybe deprives you of $50,000 to $80,000, which is your total life savings. I'm sorry, but the correct remedy is give them the $50,000 to $80,000 and get to the business, making sure that that person either isn't practicing or is practicing only in an area where they're competent.
Since Randy's head is down, I'm going to take advantage of him not looking. I'm very interested in your comments regarding MCLE and attorneys having specialized practice areas. It's not directly within the scope of this group, but we began to look at that issue a few years ago, I think maybe 4 years ago, and it got derailed by circumstances at the bar. But it raises some very important issues that if we could correct some of the problems before they happen with actual competence.
Well, to me, that's the definition of what an attorney does. The definition of any professional. The definition of a professional's primary goal in life should be to prevent the need for their services. That's really what you should be doing, and that's what attorneys should be doing. And some of them do. The best attorneys prevent disputes and resolve them and make sure people are behaving lawfully and so forth. And that's what we need to do. We need to do that. Now, I think your role here obviously is limited to some extent, but I think you can at least make some comments in your report about the need to prevent, because that's there. That's why I emphasize this so much. I emphasize it kind of as a way of saying, you haven't prevented, so you have to do something about it, guys. You're the ones who haven't prevented. I'm kind of giving you ammunition here, okay? That's my purpose. But if they were to prevent, all that would mean is you'd have fewer claims made. But you still should be paying the claims. But you have an interest in doing it because you're paying for it, and you are paying for it. That North Carolina case, I don't think anyone in the bar is apparently very aware of it. You know what I'm talking about when I say North Carolina case? Well, you two do. Anybody else?
Yeah.
Yeah? Justice Kennedy? He's not going, but believe it or not, it was a 6-3 decision. It wasn't any kind of change. And that was the decision saying that any entity, any state regulatory body controlled by active participants of the trade or profession is not a sovereign body. It's not a sovereign body. It doesn't have state action immunity. It doesn't have state action immunity if it commits antitrust violations, particularly if they're per se offenses. You're committing felony offenses, treble damages. There was a bill now which we were able to stop in the legislature to indemnify all board members from any treble damages, so that the state would have to pick it all up. Because punitive damages, theoretically, and treble damages are, I think, punitive damages, treble damages are not indemnifiable. So it's a serious matter for everyone connected to the bar to be aware of. And I say that because I spent 9 years as an antitrust prosecutor. I have 22 judgments, including some involving state agencies. And this is very real. And every time you turn around and say, I'm sorry, you can't practice, where you're going to have a passage rate of 40%, New York is 90, but here it's going to be 40, because we're so much better than New Yorkers are, you're restraining trade on a per se level, per se category. Now we now have the Supreme Court is kind of getting the idea, the state Supreme Court getting the idea, and they're engaging what's called active supervision, which you have to prevent liability. Just beginning to, although they don't seem to understand that you can't have active supervision in a way that simply delegates everything to other attorneys, which is what they're doing. But theoretically, you should create some kind of commission or body that is not attorney, not active participant, not contaminated. And I know it's horrible to have someone say, you're all contaminated, but you are, we are, I am too. We can't be the ones making these decisions. Someone else has to do it. We have to have someone else do it. And so, and the irony of it is, on this prevention side, I want more restraints. I want more restraints. I want people to be competent in the area of actually practicing and relied upon by consumers. That is an antitrust trade. It's got to be done by an entity that is outside the active participants in the profession. No one seems to get that. So you should be making those kinds of recommendations, I think, absolutely. And I'd be glad to help you, with proposals, if you want to see proposals. Happy to. Okay.
Professor, I agree with your comments and your joinder of the idea of, part of the problem here is competence. We don't govern ourselves very well. We don't train ourselves very well. There's no standardized way of measuring an attorney's competence over the course of their career other than doing your MCLEs every 3 years. I think we all realize it's probably beyond the scope of this committee to take on that issue, but I do understand how that is sort of a stepping stone to the greater problem, and that is if we find a way to remedy lawyer incompetence, or at least attempt to regulate that in some way, that'll mean there's less need for insurance down the road. So it's sort of all part of the same ball of wax. I agree with that, but that's a big issue. But I do understand the overlaps. In terms of your idea on
redress, I was interested in a couple of things in your testimony and your remarks today. First of all, one that we struggled with here, and that is, how do we prove or legitimize this idea that there are members of the attorney service buying public that are going without an adequate remedy because a lawyer is uninsured? We've only been able to come up with anecdotal information on something like that. We have a hard time trying to measure it or substantiate it. And I know you mentioned in your testimony that it's certainly a phenomenon that you've seen through yourself or through friends. Can you give us some more thoughts on that, how you see us looking at that, and whether it's something that is quantifiable in some ways?
Very good question. It's difficult because, of course, you're deliberately not allowing something, and then you're wondering what would happen if you allowed it. Because these attorneys who are running naked, I mean, you can to some extent look at the suits that are brought, and to some extent do some, I think, legitimate extension of how that would translate over to the groups of the people who are not covered. I happen to think that people who are not covered are actually committing more malpractice than people who are covered for a lot of reasons. But so you can make some minimus judgments there. But as someone who has dealt with how to influence people in terms of the legislature and so forth, and agencies, I've known, and you're in the same boat I've been in my work on behalf of children. I'm the director of the Children's Advocacy Institute, and we have the same kind of problem that we have children in foster care. It's a secret system. You don't know who they are, you don't know what's going on, someone's killed, you can't even talk about it. So no one knows about it. You know what you do? You take a very visible, extreme example. So we have the Chelsea's Law. That's why we have I'm just being frank with you now. I mean, again, I got tenure, so I don't care. We got a Chelsea's Law. We got an Amber Alert. Why do we have an Amber Alert? Because someone did a study of how effective blah, blah, blah is, or they did a longitudinal sociological survey? No. Because of Amber. And because of Chelsea. And so forth. So all you need to do here is to find 3 or 4 examples of people who have been left on the wayside, seriously damaged. And if you want a place to go for those examples, I suggest the plaintiff malpractice bar. Scott Harris, David Cameron Carr, I think he's going to be here this afternoon or later on or whatever, sometime soon.
You're all ready.
Okay. Those are people you want to talk to about that, because they should be able to give you some examples. All you need is 1 or 2 or 3 extreme examples, and you'll get the juices flowing.
Yeah, we certainly know it's out there, sort of like the X-Files. And I agree, it's part of our job to try to capture that in some way. One of the things I've always remarked about in looking at the mandatory insurance issue, even going back a few years before the working group was put together, is maybe it's good, maybe it's bad, but we don't have that prototypical example of a bunch of nuns getting run over in the street, and they hire an incompetent lawyer, and he or she waits too long to file the lawsuit, and they're without a remedy, and he doesn't have any insurance.
Exactly.
There you go. Doctors had that 25 or 30 years ago, which is why the public and then the legislature eventually reacted to all that in a way. The doctors have a stronger lobby, so they actually came out okay.
Tell me about it.
Yeah. So, but we've largely been free from some sort of headline-grabbing situation like that. But it doesn't mean the sentiment is not there. You mentioned the legislature is not happy with the state bar. Maybe that's the case here as well. But wherever it's coming from, and, it's driven by this idea of need.
You're going to get support for this. And we're going to be, to the extent you do anything that's helpful, we're going to be right there with you, pitching away.
One of the things I keep coming back to on this, and it's more of an organic idea than anything else, but I know that you'll empathize with this thought, and that is, isn't there sort of a greater good here, that we're an honorable profession, maybe the most honorable profession, and shouldn't we be governing ourselves accordingly? Competent, sure, but in terms of making sure that our clients, the people that pay for our services, are not left bereft of a remedy at the end of the day. It shouldn't just be the right thing to do.
Sure, absolutely. We don't want to really kind of abuse that. It was abused, for example, in the Goldfarb case. The Goldfarb case is the case, the antitrust case. I'm very good at recommending antitrust cases, where the Virginia State Bar decided to price fix instead of minimum for what the fee should be, and they were sued, and their defense was, we're a noble profession. And I thought that was, come on. And the Supreme Court said, no, that's nothing noble about price fixing. So we failed. But I think there is something to the idea that the profession should be noble. As I said, try to remove the need for your services. And I think lawyers, to the extent they see themselves that way, and I don't think they've been that way, as my testimony indicates. I don't think they've been anything near that way. I mean, let me just tell you something. Okay, let me just indulge me. This Kennedy opinion about North Carolina talks about how people in the professions and trades get together and they form kind of an affinity group. And of course, I'm so aware of this now because we're looking at, and it's not just the bar. All the agencies have this problem. All of them do, to actually a much greater degree than the bar does. They look at themselves differently. And I first became aware of this, okay, when I was just out of law school, about 2 or 3 years out of law school, and my sister, who's a doctor, was having a party. Okay, my sister and brother are both doctors, and she's having a party, and they're all doctors there, and they're walking around saying, "You're a lawyer," and I get certain sneers, okay, and sarcastic comments, and so forth. All they wanted to talk about was, whether this particular tube will work with that particular artery, and blah 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 blah. And then my sister said, "Oh, I think George is here. He's a lawyer," and I said, "Thank God, someone I can talk to, someone who's logical." Someone who's gone through the same thing, understands the issues, understands the concept of precedence, and understands the need to be consistent in what you're arguing. George, come over here. That was I became aware, wait a second. I am in an affinity group. I do feel a certain bond with people in my group. And then when I got into doing regulatory work and so forth, and public interest work, and I saw the California Medical Association at work, and I saw the CMA doing all sorts of things in defending addicted doctors, for example, that if you took any one of the individual members and you said, should so-and-so be practicing medicine, by the way, they're on meth right now, they would say no. But CMA, when you get them in a group, you get them in an association, very bad things happen. People are very bad in groups. Okay, they gravitate to the lowest common denominator. Now, what you're talking about, your chair's talking about, is the fact that theoretically lawyers and doctors and certain others should be different, and we should be. I don't think we are enough, but we should be. We want to be. We think we are even. So let's live up to it.
Can I comment on that?
Of course, John.
My concern is, as a regulatory agency, it shouldn't be our job to regulate morality. And a decision to carry insurance is a business decision that may be driven by it's the right thing to do. But unless there's data, some definition that there's a problem we're trying to fix, I'm troubled by that being the reason why we would do it, just because it's a quote-unquote right thing. I just don't think that as a regulatory
Well, there are different kinds of right things. There are right things because your sense of morality or your Christian beliefs or your Jewish beliefs or whatever. And when I say right thing, I mean right thing in terms of the goals of a profession and the goal of a regulatory agency. Profession is supposed to serve the public. Number one mandate, we got it through the legislature about 6 or 7 years ago. And the regulator is supposed to be preventing harm and providing redress. So I'm not, my speech about nobility notwithstanding, I look at that as maybe an argument you make. I don't look at it as a rationale.
So in your opinion, the regulatory agency should provide redress for malpractice as opposed to disciplinary violations?
It should do both. It should do both. It should prevent harm because of the practice of the profession that you are regulating, and where it fails, it should make sure there is redress because it's the one that's failed. You're the one who decide, we're the ones who decide who practices and the terms of their practice, and what qualifies them, and how competent they have to be, whether they can remain. We decide that. So if we decide that, and we screw up, and someone's hurt, we should make sure that there's redress.
So I have a question about on the competence issue. So clearly, I think we all would agree, more competent lawyers is a better thing. And obviously, if we can improve the competence of the legal profession, that's better. One way to do that would be to lop off the bottom 20%, or to raise the bar passage rate to, so it's harder and harder to get there.
No.
But hold on. But every time you try to improve the competence by, regulating or whatever else you're doing, you're going to lower the number of lawyers. And so you're going to end up with maybe fewer malpractice claims, but part of that's going to be because you have fewer people who can find a lawyer. This is what the medical profession has struggled with when they try to get nurse practitioners and physician's assistants and all these other non-doctors to come in and practice, even though they don't have the same skill level, but it's a way to sort of get more people to have access to doctors. So how does raising the competence, how does that relate to this idea that you're going to have fewer lawyers?
You can have more lawyers and more competence, and that's my idea. My idea is you have a general precedent-setting bar exam, and you pass 80-90% like New York does, okay? That gives you a huge supply. And then you assure competence on point in the area they're actually practicing. Every 5 years, they have to take a quiz or exam or whatever. If they flunk, they have 6 months on probation to get it right and straighten it out. You have a system that operates with both volume and quality. Right now, we have neither. We cut people off on an irrelevant basis, and then we don't assure any competence in the area of actual practice.
Cut people off, meaning to take it.
We cut them off. We cut 60% of people off of the bar exam.
Yeah, that's okay. Yeah, Jay.
I apologize, I didn't come across your testimony. I'm sort of joining this group midstream, so perhaps you talk expressly about this. I do like the idea. I don't think we're going astray to talk about prevention of problems in addition to indemnifying when there's a loss. To me, the idea is, should you mandate insurance? Too often we talk about insurance as a pot of money at the end of a lawsuit. Whereas in the ideal world, and if we assume all insurance people are noble like lawyers, they have great loss avoidance strategies and education and ongoing processes. You're paying for professional claims handling and assessment services. Maybe defense costs are the only thing that don't necessarily help the public. And then you have the indemnity at the end. So what I'm wondering is your broader vision, can insurance as a product still play that role, perhaps with some prodding, but to say insurance, it's sort of like health insurance. We've got all concerned in this country, everyone needs health insurance. No, everyone needs to be healthy, and when they're not healthy, access to doctors. That's the real issue. And I'm wondering what is your view on insurance, being a device that ensures that clients get competent lawyers, and if something goes wrong, there's some redress. Is insurance a good device to begin thinking about how to accomplish those goals?
I think insurers are obviously interested in lowering costs, and that means having more competent lawyers and preventing. I mean, any insurance company does. When we had my child advocacy work, the swimming pool standard, we had the trial lawyers and the insurance industry testifying in favor of our safety measures. Because the insurers didn't want to cut costs, and the trial lawyers, to their credit, this is underlying your chairman's noble profession idea, so we don't want these cases, we don't want these child traffickers. But the trouble is, to keep this in mind, the insurance companies don't control the bar, they don't control qualification, they don't control competence at all. They can lobby the bar. I think they would be lobbying the bar. Would you please give us a more competent attorney? Will you please, in immigration law, have some people who know something about immigration law, require something about immigration law, because we have free claims here now, blah, blah, blah. Yeah, there could be a lobby, but the mechanism has got, that's why I like the idea of having feedback, so that the bar that's supposed to be doing this quality control is also paying the price when it doesn't. That to me is fair.
I have an idea I'd like to float by you. What do you think about the idea that an attorney would have to take an exam if they didn't have insurance? Every 5 years, that's your choice. You have insurance, you have to be constantly proving your competence.
Well, I think if it's in the area they practice,
Right.
you're assuming that, it's an area they practice.
Yes, they would have to select an area and be examined.
That would be a fallback position. I mean, I like the idea of redress, but I like both. I like to do both, okay? But it would be better than nothing.
I'm curious how you define, you said there's 24 categories. In the lawyers that I see, there are many lawyers that practice in a number of areas. Now, maybe that's not ideal, but that's the reality. And so are you suggesting that the bar should also regulate and not allow lawyers to practice in more than one area?
I think lawyers should practice in areas where they can prove or demonstrate some minimal competence. And I really don't think, you know, law school professors seeing what's going on, I think there are very few lawyers who can practice in more than 2 or 3 of those 24 areas. You can find a lawyer who can practice bankruptcy law, juvenile law, antitrust law, admiralty law, you know. No, that's not the world today. It doesn't work that way. To be a bankruptcy lawyer, you have to know a lot about bankruptcy. You're going to be a bankruptcy lawyer in all, you know, and maybe something like tax or probate may interact in various ways. That's why I say maybe 2 or 3 at most. But go through my list in my testimony in the footnote and show me anyone who practices in more than 3 of those 24. You'll have trouble finding them.
Go ahead, Steve. We see that on a regular basis when we get our one-page premium indication forms. We see attorneys that dabble in, you know, 6 or 7, and we just decline them now. And I think that will, you know, prove beneficial for the carrier.
Yeah.
It doesn't necessarily help the public, though.
Well, the dabblers are a danger.
Right.
And you're right to deny them coverage. I would too. That's why maybe my 923 would have been less, my premium here, if I hadn't put 3 different areas that are unrelated in my in my application.
You didn't get that 923 for me, though.
One of the things that we recognized here, maybe even struggled with a little bit, Professor Falmouth, was the idea of mandated professional liability coverage would bring with it sort of a downside to those members of the profession that practice in low compensated areas or reduced rates or restricted rates or even pro bono and low bono work, and telling all California lawyers across the board that they have to buy legal malpractice insurance, especially at the sort of premium structure that we have here in California, which is you know, now is higher than probably most every state, or is certainly higher than most every state. And the effect is driving them from their practice and therefore leaving the public with a very, very valuable, without a very, very valuable resource that's provided by those lawyers. You know, you practicing the public interest law for a number of years and being involved at the university level, this is a near and dear issue to you. How do we balance those two by creating a system where everybody's got to be insured, but making it achievable by those that practice in sort of marginalized, compensated areas?
Well, I think you've got to understand and appreciate the fact that we set up a system where someone's going to have to spend $500,000 in higher education to become a lawyer. In terms of their $40,000 a year tuition, or at least 30 or 20 at most, at least, and then the living costs for 7 years. We have this system of incredible expense, and then to say, well, they're not making enough money, they can't afford this. Huh. If you know that you're going to have to pay $1,000, $2,000, whatever it is, $1,500, $500 a year for this to practice, that's part of the cost of practice. No, the fees should be $800 or $900. Just the fees we got that changed too. They were called dues. And this year, the legislation is going to call them fees, not dues.
Right, and we are all licensees now.
Yes, you're all licensees now. You're not members of the club. And we also got the change to the board, instead of board of governors, where you all walk around calling each other governor, which really pissed us off. We got to change the board of trustees. That was another one of our bills. But anyhow, yeah, I sympathize with that group. Those are my students. Those are people. I have their pictures up on my wall. I have 50 of my I call them the change maker, trailblazer wall, and I love them. I care about them, and I want to help them. And we have this system in place where I and the faculty of the law schools contribute, not just my law school, but at least 10 other law schools I know of, to pay money to pay off the loans of those people who are doing that work. And as I said, the bar ought to be doing that with the $105,000 that the medical folks do for their doctors. Why don't we do that? We give them $105,000 like the doctors do. I don't think they're going to have much of a problem making $1,500 a year in premium payments. So don't take an area of injustice and wrong and need and use it to justify the sacrifice of something else that's needed, that's at the center of your obligation as regulator. It should be ground zero. It should be the starting point. It should be the floor. Now, if you can make the floor a little easier to climb, fine. And I want you to do that. And that's why I suggested the idea of using the Plan Security Fund and have that system of cross-subsidy from other attorneys. That's a way of accomplishing that, so it would cost very little. And I do notice with Linda's very useful survey of, can I afford it, et cetera, and half say they can't. Well, I think it depends on at what level and whether there's a cross-subsidy, and whether you're going to, if you require, $500,000 per claim or whatever, you're going to have a serious problem. $100,000, maybe you go down to $50,000 for those. You have a special category for those people, so they only have to pay $500 or $600 instead of $1,200. You should figure it out. I think you're on the right track. I like your discussion here. I like your discussing the fact that, well, I thought it should be more than 100, but now I think it might be enough. Because I kind of think it might be enough too. Because, especially for the people you're most concerned about. Because they're not going to have $500,000 claims. They're not going to be losing $500,000. They're going to be losing, when I say losing, generally it's going to be $50,000 to $100,000 if you screw up. So cover them for that. And make everybody do it. And that's the floor. That's what everybody has to do. Because you as a regulator said that's what everybody has to do. And my peeps are going to have to pay it. And I don't feel good about it, but I think you should do it. You should make it.
Right. Well, some of those problems we can't solve. It's a little bit beyond our scope. Law school education and loans and...
Just want to say it's partly my fault.
Yeah. And State Bar, dues bill, and those sorts of things. And there's, certainly lots of carriers out there, including in this room, that would love to insure lawyers like that at the appropriate level, whether that is, a limit of $100,000 or $500,000. I think we probably agree that the exposure for that sort of work is probably nominal, if anything. We just want to make sure that they can afford it when
Sure.
if the state tells them that they have to be.
Sure, I get that.
And we're worried about, marginalizing that sector of our lawyers.
It's my sector. I'm with you. I understand.
Okay. Anybody else have comments for Professor Feldman?
Thank you. I wanted to say that it's been 28 years since I suggested that this happened. Some of you, I think, were in elementary school when I suggested it back in '89, but maybe not, maybe high school. But I'm glad to see not only that it's happening, but this is the group that's doing it. I'm very heartened by that.
Well, thank you. Yeah, we're blessed to have a really experienced group of committed working group members here, and I'm certain we'll get to the bottom of all these issues. As you've seen the list of the questions that the legislature wants us to answer, we've got our work cut out for us, and but we're up to the task. But we appreciate your involvement and your commitment to come here today, and your thoughts on how you see this world.
Thank you very much.
Okay.
Thank you.
Thank you.
Thank you.
Okay. Anything else that I'm missing? I have a couple other thoughts. Let's see. Let's just go right through. And a couple. Any afterthought on any of that? Realizing we're still on live feed here.
I just have an afterthought because we're talking a lot about just this public interest group, and for solo and small firms, that is a portion of that group, but it's not the majority portion of that group. So in some ways, I think that we're kind of skipping over another large population, which is just the general practitioners that are solo and small firms that don't do public interest. So I just wanted to, because that seemed to me mostly based on that and that alone. So I just wanted to bring that back into the conversation as well.
Yeah, and I agree, and that's based on the discussion we had at the last committee meeting. A lot of the lawyers that practice in public interest law are part of an organization that has a minimal requirement, their own, coverage in place. So, it might be once we weed our way through all the, various strata of the lawyer population here, there may be a very small number of lawyers that practice, in a rate sensitive area or low bono or pro bono work that are actually without coverage now and would find it difficult to purchase coverage in the future. I don't know how big of a problem that is, but the information we've gotten here over the last couple of committee meetings has been really helpful to me to start to understand that piece, because that is a really tough piece, I think, for us, that if we put this program in place, how many of those people are going to eliminate just by virtue of a cost, from the profession. So, yeah.
So, Randy, as we've been going through today, we've heard a variety of ideas short of mandatory malpractice insurance. This idea of a competency test every 5 years. Obviously, the Illinois PMBR program that you and I have dealt with extensively is already on our radar screen. There's a lot of ideas that go beyond just strengthening the notification rule. And I was, I just don't have it in my head, but I was hoping maybe you could remind us when we, as a group, will be able to, fully discuss and vet alternate ideas short of malpractice, other than strengthening of the notification rule. And perhaps if we should have some process in place for the submission of ideas in advance of that meeting. Sometimes we do that in the Rules Revision Commission, where an idea would be, the ideas that would be discussed at the meeting were basically a questionnaire was put out to the entire committee in advance to solicit ideas. So anyway, it's just something I'm personally interested in, because a lot of really good and potentially viable ideas have been thrown out there, and I'm just wondering when we bring that all together.
It's a great observation. I was going to ask, do you know when we're doing, just thank you.
Well, so the next meeting, the August 27th meeting includes the topic alternatives to mandatory malpractice insurance. And that's when we are having someone from the Illinois ARDC, but I think that's a broader topic than just the Illinois model.
Excellent. Maybe we want to consider doing some type of solicitation of ideas in advance from the committee, just an idea. Because I had this whole thing about competency testing every 5 years. I've literally never heard that exact idea before. And I'm sure other people have good ideas. Because I personally am interested in hearing about more than just how we strengthen the notification rule.
Yeah, actually, the next committee meeting, working group meeting, we have two issues: the alternative to mandatory malpractice insurance, and then disclosure requirements. Those are biggies. And I agree. There's a lot of ideas sort of that came to us in a direct way, and then maybe just because of our putting our brain power to it, we've come up with other ideas. I want to make sure that we're faithful to the actual questions that are asked, and we don't meander too far in areas that the Board of Trustees or the legislature not interested in hearing from us. But it's all part of the same thing. I mean, I think there's probably virtually nothing that's completely off limits, and the idea, or at least the recognition, that there's other ways to skin this cat maybe would be a good thing to do. I like that thought, and we'll give some thought to maybe in advance of the next meeting, just to collect all that in one place. Although, who's on the alternative and disclosure committee?
Well, the disclosure committee.
Disclosure. Yeah. Oh, did you divide it up?
Well, I think there's two, but we're actually combining them both for the 27th.
Yeah. Okay.
It'll be somewhat of a joint presentation.
Right. Okay. All right. Yeah, good. I mean, this is a helpful process to hear from others that are working in the same areas as we are, as to other ways to look at the bigger issue here. And then, at the end of the day, public protection, we are told that that's the law of the land. So that's ultimately where we end up with all of this. Anything else about Professor Feldman's comments?
One of the things that I wanted to put out that I've given some thought to between the last meeting and today was some sort of a more robust public pronouncement of what we're doing here. And I know we've got a public comment period when we get way, way down the road. You know, I don't know that I have super reliable information. I've talked to a lot of people about what I do and what this committee does and what the sort of things we're studying. I haven't heard a lot of people go, oh yeah, I've read up on that and I know exactly what you're doing. I'm very interested in the process. And there should be, you know, about 100,000 lawyers practicing in small and solo shops here in California that really, really care about this. We put out a questionnaire, that's great. The information that we needed there to get from that process is super valuable. But I feel like there should be a place for us to publicize this so that we make sure that we don't have people scratching their heads when we deliver this product next March and it's put out for public comment. They go, yeah, I wish I would have known about this. It may be nothing more than this is what we're doing. Obviously, everything's posted online. We've got our agenda. In fact, all of our meetings are there, and you know, Linda does a great job in populating that with all the information that we look at. But I'll put this out to everybody. Where would be an appropriate place to make that? You know, we used to have the California Lawyer magazine, and we would put it there and get a fair amount of eyeballs. If we put it in the disciplinary section, everybody reads that. Oh, I knew that guy in law school. Oh my God, tool. So no, we're not going to put it there. But where would be a place for it?
Yeah,
so
I think that's a good task to assign to us as staff. That we have some different options that I'm thinking about, and we still do a version of the CalBAR Journal,
right.
Which we could include. We could kind of put it right next to the links to the discipline to try to increase the hit rate. But then we also have a call once a month with local bar associations, the chair of the board and myself. And we can certainly have Linda participate in that call, provide an update, and then a very brief written update that we can send out to the locals to then include in their communiques, because this is a group that I think would be most interested. We have provided them with a couple of updates along the way. But we can brainstorm this a little bit more and certainly come back with a communications plan. I think you're right.
And Randy, the California Lawyers Association, we'd be very happy to distribute it as well. So if you know, the information comes to us, we'll include it in our newsletter and our other communications. So that should you know, help.
Yeah, great. Those are two great ideas. Heather and I and Linda, I can't recall who else, have also volunteered to put on a program for the ABA, which we actually did in the spring. Legal Malpractice Standing Committee, but it offered to do it again in the fall at the next ABA Standing Committee meeting, just as a means of getting it out there. It's not just California lawyers, it's you know, coast to coast, but it heavily involves the insurance industry and brokers. I think I know most insurance companies have their sort of eyeballs here that want to write and do write in California. They're looking at this. I know other state bars are looking at us. Heather put together a great program in the spring ABA meeting to get the word out there. Then there was a lot of interest. I just want to make sure we continue that momentum and have it out there to as many people as possible, so there's no people that haven't been, at least we attempted to inform about all of this. What we're doing is obviously a very public thing, a very important thing. I just want to make sure that we're taking advantage of the opportunity to publicize this to everybody. Right? Okay. So.
Randy, maybe you could do a free MCLE, like a webinar kind of a thing statewide. Everybody also does that if it's free.
Yeah, I thought about that as well. I even thought about you know, sort of a bar association tour, and then thought I don't have time for that. But if I could borrow your 1965 station wagon, we could put some pictures on it. You could just drive around, you know, or a whistle stop or something like that. Or at least maybe the big bars. I mean, I'm here in LA. I'd be happy to do something for the bar association here. A lot of their active members are sole practitioners and 1 to 5s, and you know, even if it's just 10 minutes. So those are sort of the things. But we can talk about more. You guys we've got great resources in the state bar and in bar associations. It'd be fairly easy to put together. What do you guys think about that?
Randy, a couple other ideas too. If you wanted to do some type of webinar free, we hosted at CLA as well. And, I mean, it's just an offer. There's obviously a lot of state bar resources available to you, but you know, our offer stands as well. And CLA is having its annual meeting in San Diego, September 14th and 15th. And if we wanted, and then we'll hopefully, it's in conjunction with the Bench Bar Coalition, California Women Lawyers, Conference of Delegates, the California Judges Association, and other groups. So it's going to be a lot of lawyers and judges in San Diego that weekend. If we wanted to set up some type of, you know, booth or pass out informational materials or use that forum to get the word out to, you know, basically what you're discussing, that would be available as well. So these are things for you and Linda to consider, but the offer is there.
Yeah, great, thanks. One-stop shop, a lot of people get the word out too. Anybody have a sense of the carriers and the brokers here in the room? Is it, how much is this as a known thing out there?
I mean, CNA, I speak to about it regularly.
Your mic.
Oh, sorry. More so to obtain more information from the actuaries, and, you know, demand or ask for data on this, but they don't view it as a concern. They view it as a good thing if we put mandatory insurance in place out here, because they feel there'll be people in the pool that feel they don't need it, rightfully so, that will have to buy it. You know, if we start throwing around objections that, you know, they're gonna have to take all these risks that they wouldn't generally take, that could change their thinking.
It's a different thing,
dramatically.
of course. Yeah, all right. So it's sort of like affordable care in a way, you know, because, you know, a lot of carriers dove in on that thinking, well, we're gonna get a lot of business. And they did. I don't know how probable it is or will be, but, you know, there at least is an initial interest in it, I would think.
And the other area that I have interacted with the hierarchy at CNA is on that value plan that I mentioned briefly earlier, where if you had a lower income, you qualified for these, you know, very inexpensive premiums. And they agreed that if in fact that was to become a mandatory situation out here, they would bring that product to California. So.
Okay, good to know. Okay.
Yeah, in terms of Lawyers Mutual, I don't know that we have a position either way, and it cuts both ways. The inquiries that I have been getting is primarily from larger brokers. They're like, what the heck is happening with the state bar? Are they gonna have one carrier, one broker? The really industrious ones want to know how they can be that broker. So a lot of confusion, and some of them are calling you misinformation that I have to kind of straighten out. So there are large brokerage houses that need to be informed, just because they control a good portion of their marketplace with the lawyers they bring to be insured.
Yeah, you know, there is one version of that story that is, you know, high anxiety. You know, as we know, there's big brokers in this world that would have, if they're on the outside looking in, things would change dramatically, especially in California being such a, you know, a plum state for the most part, for employers with insurance. So, but that sort of goes back to the idea of making sure that everybody's informed of this, so they don't have misinformation about, you know, what's going on, and, you know, where this, you know, cabal of you know, doll stickers that sticking pins into dolls about what the future is going to look like here. So, yeah, just want to make sure. Okay, we're done, I think, with our formal agenda for the day. So I wanted to open it up to any further comments, and if there are none, we could.
Procedurally, you need to ask for public comment.
Yeah. Anything else before? Okay.
Just one thing really quickly. I know I just heard from Glenn that Dan Pennington may be unavailable that day, but I would urge us to try to find a time to have Dan Pennington himself personally present to us, because again, he's the best speaker I've ever heard on this topic, and it's so clear and so concise, and if people here are interested in mandatory malpractice insurance, he's the guy that will have all the facts and figures at his fingertips. So I just put that out there. Even if it doesn't work on that day, maybe he could come another day, and we could. I just think it's really, really, really important. And Randy, you know Dan, and he's presented hopefully before. But I think we'd be doing this committee a huge disservice if we didn't
put Dan in there somewhere.
Yeah, we unfortunately landed on the day where he does his annual review, and then the ex-CEO of Law Pro apparently is the second best person to address this. They can appear by video, so there's no problem with that given the time. So we're in good shape on that. But I've also heard the VC person very highly recommended too, so we may want to have her as well. So I think we have the opportunity to hear from two of the provincial programs on them. Well, we will get them here.
Thank you.
Yeah, Dan is a great resource, and it's encyclopedic in what he comes up with. I mean, he knows all the metrics and details of these programs from all perspectives, sales, marketing, underwriting, actuarial, and because that's what they do successfully for a number of years. So he's a great resource. A lot of things we've been asking here about what does this look like and how does it burden the lawyer insurance buying constituency. Those are all issues that they look at for years. So unless there's anything else from our working group, I will open it up now to any public comment. I announced at the beginning of today's meeting that we would leave time at the end of our meeting for any public comment. So I invite anybody who wants an opportunity and a podium to speak with us. Now is your opportunity to do so. Okay. Hearing nothing. We have our next meeting scheduled. We are back up in San Francisco.
August 27th.
August 27th. And we've got two committees reporting to us then on disclosure. Scott, are you the...
For the disclosure.
Disclosure.
And we've been coordinating, so we'll have probably a combined report.
Okay. All right. Perfect. I mean, another great topic that will benefit from being fleshed out before this committee. If nothing else, we'll all be educated on that. We have, I don't know how many states now have some form of disclosure, 25, 30, and many states have some form of it out there. So there's a lot of precedent for these types of rules being in place. And frankly, it probably is sort of a compromise, I think, of a lot of states have come up with to sort of force the issue and tell the legislature and the members of the public that they're doing something about this, but without actually mandating the insurance is sort of what you hope that goes. But and they're different from state to state. And did I hear from somebody earlier that one state had actually rescinded its disclosure rule? Who did I hear that from? Was that you, Carolina?
Yep.
Rescinded?
Yes.
It was sort of miscast and not very helpful to the lawyers, but even worse to the public. And so they eventually reversed course on that altogether. Not saying that's
We don't want that.
a possibility here. I may have been more in the execution than anything else, but I'm certain they tried very hard. Okay, with that, unless anybody has anything else, we will adjourn for today. And I thank you again for all of your time and effort and commitment to be here. Appreciate your involvement.
Hey.